lot more power over the fate of the deal as Teamsters boss Sean O'Brien imposed limits on his own power to decide such things back in 2021. So he can't impose a contract if more than half of the workers reject it. And some are on that path, as the organizer of a Veto No campaign says O'Brien overpromised and underdelivered.
Thanks, Erica. Warren Buffett isn't fretting over Fitch's U.S. credit rating downgrade. The Berkshire Hathaway boss tells CNBC there are some things people shouldn't worry about, and this is one. Those are the company stories we're following this hour. I'm Steve Rappaport. This is Bloomberg. More Bloomberg Markets with Paul Sweeney coming up right after this.
You're listening to Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, Jess Metton and Paul Sweeney here in the Bloomberg Interactive Brokers studio. Looking at these markets, got a little bit of a sell-off here. Continuing today, the S&P 500 off 0.5%. NASDAQ off about 0.4%. Want to keep an eye on the yield market. That's where we're seeing some action here. The 10-year Treasury yield up 11 basis points, 4.19%. The 2-year is up just 1 basis point. So a little bit of yield curve steepening here. The 2 years at 4.88%. WTI crude oil resumes its move higher, up 1.3% today to $80.51. So energy continues to be front and center. Right now, let's head down to Washington, D.C. We'll get enrolled in national news, and we will do that with Amy Mars.
All right, thank you, Paul. Former President Donald Trump is expected to appear in a Washington federal court this afternoon, facing new charges that he conspired to obstruct the 2020 presidential election. That hearing is set for 4 o'clock Eastern Time. This as the Secret Service says it's working with D.C. police and federal officers to ensure Trump's security. Capitol Police Chief Tom Manger.
We've been working with our partner agencies here, MPD, U.S. Park, Secret Service, Federal Protection Service. We've all been working together.
Capitol Police Chief Tom Manger says they've been working on this for a few weeks, and he says they're ready. Republican donors who oppose Donald Trump might be making a mistake by spreading cash across the GOP field, not just focusing on one candidate who could defeat Trump for the nomination. And that creates a dream scenario for the former president, splitting the money and the support from influential voices among the roughly dozen candidates in the race. Party insiders worry that Trump's mounting legal problems will make it impossible for him to beat President Biden. Two former U.S. Treasury secretaries urged Washington policymakers to address the country's long-term fiscal challenges before they're insurmountable. Tim Geithner tells Bloomberg's Wall Street Week that the system has to act before it's too late and too hard.
These long-term things that are very hard, you can't do with just one party. You have to do them in a way that commands broader support across the political spectrum, and you have to build that.
Geithner and Hank Paulson are co-chairs of the Aspen Economic Strategy Group, which is convening a conference this week to discuss building a more resilient U.S. economy. At least 13 people have been injured in South Korea. A man rammed his car into a sidewalk and then stepped out of the vehicle and started to stab people near a subway station. Police have a suspect in custody. They're questioning him now. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Amy Morris, and this is Bloomberg. Paul and Jess.
Thank you, Amy. We appreciate it. Jess Mitten and Paulie Sweeney here in the Bloomberg Interactive Broker Studio. And I always love checking out what the big take is every day on the terminal. And this one, reading off the headline here, murder, money, and the battle for a pharmaceutical empire. So we have reporters taking a look at who murdered when you're looking at Barry and Honey Sherman. So this was a pharmaceutical billionaire here, and the mystery surrounding that. They're looking at how two of these wealthiest people ever were unfortunately murdered, and police just still haven't identified who the killers are. But along the way, they've turned up no shortage of potential suspects. So going through this and digging into it, it's always fascinating to read through mysteries like this, Paul.
Yeah, and Amy Morris was just saying in our group chat, boy, this is like a movie. This article on the Bloomberg terminal, it just kind of writes itself as it relates to some kind of movie here. But again, two of the wealthier people in Canada, very high profile up there. And, it's amazing that there are just no suspects years after this occurred.
Right, about 5 years.
Yeah, 5 years. It's still an open case, but they still have really nobody's been arrested. Nobody's been held accountable. Family members are under suspicion. Acquaintances are under suspicion. The family, obviously very wealthy, have funded their own investigations kind of parallel to the Toronto police force. So it's just a fascinating read here. But a big pharmaceutical company, and this is a pharmaceutical company that, would look for drugs that were kind of near going off patent and then go and then just start competing against them aggressively. So it's not a well-liked company within the industry.
Right.
So potentially some issues there.
But definitely a fascinating read for our listeners to read on the terminal.
Yep, and you can find that at Bloomberg.com/bigtake. We'll have more coming up. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe the central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this thing called AI?
This is Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, coming up in this hour, it is another pivotal day for former President Donald Trump as he'll be arraigned in Washington, D.C. at 4 p.m. Wall Street time. We're going to break it down with a smart roundtable. Caroline Fredrickson, distinguished visiting professor from practice at Georgetown Law and a senior fellow at the Brennan Center for Justice, is going to join us to talk about the legal aspects. So Wendy Schiller, professor at Brown University, will also join to offer the political perspective as well, so we'll have it well covered. We're going to talk about the markets here. Philip Colmar, managing partner and global strategist at MRB Partners. He's going to join us in studio to give us his thoughts on the markets. And then Ian Whitaker, one of the smarter TMT voices coming out of London, he's going to join us and give us his thoughts on what we're seeing from some of these big tech companies reporting earnings. So a busy hour coming up. We're going to kick it all off. John Tucker, Bloomberg Business Flash.
All right, Paul and Jess, the sell-off that we saw yesterday is extending in today's trading session. Among the things in the driver's seat, well, yields. The 10-year Treasury up 10 basis points. Right now, you have 10 of the 11 major industry groups in the S&P 500 are lower. The exception, the only one that's in the green right now, energy. That's because, in part, the Saudis are extending their output cut. They also say it could be deeper in the future, so that's got the energy prices higher today. Meantime, at Oppenheimer, the chief investment strategist there, John Stolfus, continues to make his bull case for stocks.
The economy is showing remarkable strength if we look at the GDP, based on all that's happening. Corporates are navigating through a transitional period remarkably well, with quite a few sectors still showing good growth. And then on top of it, the consumer and jobs are remaining remarkably resilient.
Right now, the S&P 500 17 points lower, down 0.4%, 44.96 on the index. The Dow Jones Industrial Average down 127 points, and the Nasdaq 100 35 points lower. That's down 0.25% right now. Those strikes in Hollywood having an impact. Warner Brothers Discovery says it's on pace to hit the lower end of its target, and the financial performance of the company is going to depend in part on when the strikes get resolved. Of course, they're the parent of, among other things, HBO. Most active right now, Advanced Micro Devices, 4% higher in today's trading. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Jess and Paul.
You know, one of our guests that we have on Talking Media, Laura Martin from Needham & Company, she made a call right at the beginning of the strikes that short-term, the strikes are actually good for the media companies because they can stop writing checks for all the programming.
Really?
So their costs will go down.
Okay.
They're still generating revenue, but of course, medium and long-term, not a good thing, and that's kind of what I think Warner Brothers Discovery is calling out today. John Tucker, thank you so much for that. Jess Menton, Paul Sweeney here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube. Just head over to youtube.com and search Bloomberg Global News. As John was just reporting, some red on the screen today. Lots of economic data, lots of earnings to get to. So let's check in with Alex Semenova. She covers all of markets for Bloomberg. She joins us here in our Bloomberg Interactive Broker Studio. Alex, what are you looking at?
Great to be on with you guys. I want to start first with a name that I'm looking at today. That is Etsy, the online marketplace for crafted goods. Shares are down more than 11% right now. Its biggest intraday decline since May 2022. This comes after the online retailer reported second quarter results and gave an outlook that Citigroup analysts said wouldn't be enough to reassure investors about its growth prospects. It's interesting because Etsy is a pandemic favorite, but it's held up a lot better than some of the peers that have fallen out of favor. Of course, the pandemic helped power its buyer, seller, and gross merchandise sales growth, but they've generally held up even after, as we get out of COVID. Analysts at Bloomberg Intelligence, however, say that their future gains are contingent on its ability to take a higher take rate from those sellers and maintain its user growth. From the folks that joined during the pandemic, also continuing its user growth. Analysts did see an increase in buyers as a bright spot for the company. D.A. Davidson said that the company is doing an admirable job setting expectations despite limited visibility and a challenging macroeconomic backdrop.
You look at that chart, guys. It is a pandemic chart.
It is. They just all look the same.
They all look the same, and this Etsy stock peaked around November 19th, 2021 at $294 a share. Here we are start $84 a share. So you kind of overlay that with a Peloton or whatever else you want to do, and it looks very similar.
I remember when our producer Eric Malo was trying to get that ornament during Christmas, and we were trying to ask and see who was buying the different products there. Another name I wanted to point out, though, I mean, just looking in general at the NASDAQ 100, just down about 0.2%. So if you are looking at particular stocks that are dragging on that index, I mean, NVIDIA, for instance, is up, so it's up more than 1%, so high weighting. But I know, Alex, you're taking a look at Qualcomm, which obviously has a big weighting too there, and is getting pressured this morning.
Yeah, that is another name today that is down 11% after giving a lackluster sales forecast for their current quarter, and also signaling that demand for smartphones is still weak. This marks the biggest intraday drop for the name since 2020. A lot of comparisons happening today with those big share moves, and this renewed some broader concerns about the smartphone industry. Some other chip-making peers also saw a steep drop in orders from handset manufacturers. Qualcomm did warn that the reduction in spending on phone parts and other electronics will continue to drag on it for the rest of the year.
Hey, Alex, you know, it's not every day that the U.S. government's credit gets downgraded. What are some of the strategists on Wall Street saying? I kind of feel like people are saying, yeah, it's not that big a deal, but it feels like it's weighing on the market here the last few days.
The consensus seems to be that the U.S. Fitch downgrade is really a non-event. You had J.P. Morgan CEO Jamie Dimon, Bank of America CEO Brian Moynihan all saying that this is not really something to worry about. I saw a tweet yesterday from Dan Loeb over at Third Point. He said that this is a cry for attention by Fitch. So it's not really that's driving stocks lower. It is just the renewed turbulence in Treasury markets. Of course, Bill Ackman today said that he was short the 30-year Treasury yields as a hedge against a global rate shock. So that's kind of adding to the bearish mood and pressuring tech shares.
But Warren Buffett on the flip side says he bought $10 billion of Treasuries last week, $10 billion of Treasuries this week. And the question for next week, when he puts another $10 billion in the marketplace, which maturities does he buy? So that's, I don't know. It's pretty bullish.
Exactly. yeah. So just like this renewed turbulence in the Treasury market that is sending shares lower. But if you look big picture, it seems like the bull case is still pretty much intact for now. You had Julian Emanuel over at Evercore ISI this morning on Bloomberg Television saying that this is a pretty normal correction given the incredible run that we've seen in the equity market. You still have the soft landing optimism, at least for now. Earnings have held up pretty well, and strategists are looking ahead to an earnings recovery next year, so that's still driving stocks higher. And you know, if you look at, there's an interesting point from Ned Davis Research. They said that anytime the S&P 500 has soared as much as it did through July, it's usually been followed by gains in the second half of the year. So far, it's really, we have to look ahead to what we see from Apple and Amazon earnings, as well as the jobs report on Friday to get a better clue about what the Fed will do in the fall.
Great stuff. As always, Alex Semenova, Bloomberg Equities reporter, joining us here in our Bloomberg Interactive Broker Studio, covering a lot of ground there. Big day for President Donald Trump. He's about to be soon leaving his golf club in New Jersey, heading down to Washington, D.C. for the arraignment there for that January 6th uprising. We're going to break it down here. Caroline Frederickson, distinguished visiting professor from practice at Georgetown Law, as well as Wendy Schiller, professor at Brown University. Caroline, I want to start with you from the legal perspective here, the legal case, the indictment that's come. I think probably one of the number one questions for a lot of folks looking at this is timing. Is this an indictment? Is this a trial that can start prior to or be concluded prior to the election?
Well, it's going to be complicated. There's no doubt that the former president is going to do everything he can to slow down the proceedings, to drag it out as long as he possibly can. But I think they're going to keep to a pretty rigorous schedule. I mean, this courthouse and Judge Chutkan have already dealt with so many January 6th trials that they are really equipped to process these as quickly as is fair, obviously, to the defendant. But I think we're going to see things move along at a pretty good clip.
Wendy, I want to bring you into this conversation. How does this latest indictment affect these other ongoing trials?
Well, I mean, I think it affects Trump's political standing in the sense of it takes a lot of money to defend himself on all these charges. And if there's another indictment that's even more, we've seen a lot of difficulty with the PAC that he had. You know, he's raising this money, he's spending it on himself and his legal fees, and now it's really mounting. So the question is, who invests in the Trump presidential campaign when, for the time being, the money is going for his legal defense now in a second federal indictment in addition to a state case? You know, at what point do even small donors say, wait a minute, what's going on?
Exactly. And Wendy, we had a guest on a day or two ago, a former prosecutor who actually was a prosecutor on the Watergate issues back in the 70s. He said of all the issues out there for President Trump from a legal perspective, this January 6th uprising is, quote, the one. How do you view what the former president will be arraigned on today versus, boy, everything else that's out there?
Well, it depends on your perspective, and I'll leave it to.
Oh, I'm sorry. Yeah, I'm sorry. I was directing that.
To
Caroline. Sorry.
Yeah, because she's the lawyer. I'm the political science professor.
Well, I'd have to say I agree with the other commentators. The other charges are obviously very serious. Stealing national security documents, obstructing investigations, efforts to recover those documents, illegal campaign payoffs. But really, when you're talking about an effort to subvert a democracy, there couldn't be anything more serious. There couldn't be a charge more serious. What was perilous for many people that day in terms of the insurrection was truly perilous for our democracy. To the extent that Donald Trump had a role in fanning the flames, and certainly in his efforts to block the certification of the election and to promote illegal or electors who were not chosen by the voters, is all very, very troubling. And I think the consequences for him are therefore that much more serious. And I think as Professor from Brown had suggested, though, that I think this is, there's also obviously a very big political impact. And the difference between, the charges of absconding with some documents, and people might think that's sort of silly or funny, or, he's such a show off. He wanted to wave around his love letters from dictators and show off plans to, the nuclear capabilities of our allies. That I think is very serious and unfortunate, right. But it pales in comparison to the idea that he was trying to, engage in a coup.
Wendy, how has the Biden administration responded to the latest indictment?
Well, the Biden administration is, keeping itself quiet, right? Because first of all, the Justice Department is separate from the presidency, and I think Biden's always been very consistent about that. And Biden's son Hunter is under investigation with a plea deal that fell apart, and so there's even more pressure on Biden to be quiet about federal investigations. But going back to the point about which case might matter more politically, I tend to differ because I think that the average American, given what Trump did to conceal the documents, erase the tapes, surveillance tapes, bully the employees, to threaten them and make them cooperate. This is like right out of The Sopranos, right? This is an unattractive version of the president of the United States. And so for the average person who tries to figure out how might this make my life worse, having a mob boss as president of the United States versus somebody who's trying to undo an election that they lost, I think for the democracy, there's no question that this January 6th is worse. Politically, I think if you're going to peel away anybody who voted for Trump in 2020, you have to say life will be more chaotic, it'll be more unpredictable, and the guy's kind of a mean, bossy, possible wannabe mob guy in the White House. Does that appeal to you? Maybe, but maybe it doesn't. And I think for the independent voters and the suburban voters who stayed away in 2020, I think they say to themselves, I don't want this kind of person in the White House.
Caroline, from a legal representation standpoint, when I look at the lawyers representing the former president, really throughout all of his issues, I don't see too many white shoe law firms. I don't see any law firms that I even recognize. Can he get in the future proper representation?
Well, he's kind of scraping the bottom of the barrel. I mean, look at what he's produced. I mean, Sidney Powell, who apparently is one of the unindicted co-conspirators, and Rudy Giuliani, who traipsed around the country making ludicrous claims on Trump's behalf. This is his legal team. they're sharing, they're sharing the defendant's table with the former president. So it's unclear, but money does often buy very good representation. We can think of all sorts of very criminals who've engaged in the most evil behavior who've gotten representation. I think he'll find it when it needs to happen. He's going to get a fair trial. But I think these indictments are pretty serious. And I guess in contrast to Wendy, I would go back to suggesting that this is the more politically consequential. I am a lawyer and not a political scientist, but I've been in politics a long time as well myself. And I just think that the way this indictment is laid out will give us the same types of stories. There was bullying. There was abusive behavior. There was attempts to strong arm people. I mean, look what he did with President Trump, with Vice President Pence, trying to get him to change his statements and telling him he's too honest. I think, as this comes out and it starts being dramatized on television, it's going to have the same kind of coloring. But I agree that the mob boss that he played in the documents case is impressive.
Exactly. Wendy, just about 30 seconds here. How do you expect the plethora of Republican candidates to deal with all of President Trump's legal issues?
Weekly, weekly as in WEAKLY, weekly, except for Chris Christie. Their big mistake is not taking this guy head on. One of the things that appeals to Trump voters is that he will fight for everybody and himself most of all, but he'll do anything for his position. And none of them have shown that they're willing to take him on head on these very core issues. And I think that's what's lacking, and that's why they're unable at the moment to peel away any of his supporters.
All right, folks. Thanks so much for joining us. Caroline Frederickson, Distinguished Visiting Professor at Georgetown Law, and Wendy Schiller, Professor at Brown University. Appreciate getting that roundtable there. And this is going to be an important day for the president and for the nation as we move forward. And again, I think for a lot of observers, one of the key questions is, when can this January 6th case come to trial? Will it be before the election?
And Donald Trump is expected to appear in federal court in Washington, D.C. later today, where he does face those criminal conspiracy charges that allege he did interfere with the 2020 presidential election. So this is the third criminal indictment against the former president since March, Paul.
And I guess the next shoe to drop as it relates to these indictments or potential indictments is the case coming out of Georgia with the voting issues there. And I guess they are wrapping up, from the reporting I've seen, wrapping up their investigation there. So that could happen at some point this summer is kind of what I've read in terms of the reporting. So we will stay on top of all of these issues. This is Bloomberg. Let's get some company news right now. Steve Rappaport.
Paul, an electric cigarette maker, is said to be seeking $1 billion in funding. Bloomberg's Joan Doniger reports.
Steve, sources tell us Juul Labs is working with Jefferies Financial Group on the fundraising effort. Juul reportedly had about $800 million in revenue last year, but the company's bracing for its valuation to drop far lower than the $38 billion it was worth in 2018. The e-cigarette maker was on the brink of bankruptcy before getting a financial lifeline from two longtime shareholders. The rescue was part of a restructuring plan that included cuts in jobs and operating expenses. Juul's fiscal problems include numerous lawsuits alleging it targeted minors in its marketing. Steve?
Thanks, Joan. The makers of two drugs that are part of a hot new trend for weight loss could pay a heavy price. More from Bloomberg's Jeff Bellinger.
Steve, a personal injury firm is suing Eli Lilly and Novo Nordisk, alleging their diabetes drugs that aid weight loss can cause a paralysis of the stomach known as gastroparesis. Attorneys for Morgan & Morgan argue a Louisiana woman became so sick after taking Ozempic and Mounjaro that she made multiple visits to an emergency room and vomited violently to the point of losing teeth. The firm says it's investigating hundreds of claims linking the drugs to gastroparesis, which slows or stops the movement of food from a person's stomach to the small intestine. Steve?
Thanks, Jeff. And Apple posts earnings after the bell today. The iPhone maker is expected to report a 1.7% drop in revenue in its fiscal third quarter. Tech giant rival Amazon will also report today. I'm Steve Rappaport, and this is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom with this Bloomberg Business Flash. The major averages, they have turned mixed right now. The NASDAQ Composite Index is up 14 points. Interesting, if you overlay the 10-year yield with the tech-heavy NASDAQ, you'll see that there is a correlation there. The 10-year yield is up right now 8 basis points. It was higher earlier. As it pulls back, the tech stocks, they get a lift, or at least that's so it appears. On the earnings front, here's a report card. 393 companies in the S&P 500 reporting so far. 81% of those delivering positive earnings surprises. And then you have Apple and Amazon, of course, reporting later in the day after the close of regular trading. S&P 500 7 points lower, pairing some of the earlier losses, down 0.2% right now, right at 4506. The Dow Jones Industrial Average 44 points lower. And again, the NASDAQ is higher. NASDAQ 100 is 12 points higher right now. And oh my God. Taylor Swift adding 15 new shows to her calendar in the fall of 2024 when she returns to North America for the second leg of the Eras tour. Fans, including the Canadian Prime Minister, who I think just separated from his wife, pleaded with Swift to add more dates. I'm start some rumors there. The latest tour on pace to gross $1 billion with a B
Swiftonomics.
So there's your.
Are you a Swifter, John? Swifty?
God, I couldn't tell you one song that Taylor Swift.
All right, we'll get you to the Meadowlands. We'll get you to the Meadowlands with 80,000 of our fans.
You should all go.
We'll throw you down in a mosh pit. See John Tucker down there with a bunch of
last place.
Beyonce was just in town last weekend.
No, sorry.
You're more of a Dead and Company or a Fish guy.
Yeah, most of the bands I follow,
like Pal, Dead and Co.
Most of the bands I follow, all the members are dead, so that gives you some indication. Anyway, that is your Bloomberg Business Flash.
All right, John Tucker,
Jess,
thank you.
Paul.
Very good, very good. Thank you. Appreciate it, John Tucker. Jess Met and Paul Sweeney here in our Bloomberg Interactive Broker Studio. Streaming live on YouTube. Go over to YouTube and check it out. You can search Bloomberg Global News, and that's where you'll find us. Markets, I think they're going to turn positive by the end of the day. This market just feels like it wants to go higher. It's coming off the lows.
NASDAQ 100.
But what do I know? Let's check in with a professional who does this stuff for a living. Philip Colmar, Managing Partner and Global Strategist for MRB Partners.
Canadian.
We picked it up pretty quick. Phil, thanks for joining us here in our Bloomberg Interactive Broker Studio. You know, 2022 was ugly. There was nowhere to go. Stocks, bonds, a 60-40 portfolio. You got crushed. Only Lisa Bromwitz, who owns a big barrel of oil in her apartment, they made money last year. But this year, a lot better. What's your market call at MRB Partners right here?
Yeah, we've been away from the recession call, so we've been favorable on equities. We continue to be. I mean, I think people are capitulating away from that call. They've gone to the soft landing call. Now, I caveat that with bond yields here. Keep an eye on them because they're brushing in against their October highs. And as long as they remain capped, you've got a window or that sweet spot for equities where you've got a economic upgrade, and yet you capped yields. We start to blow through that, which I think we will later, probably this year. Then it starts to get a bit rocky for equities again, particularly for some of those high flyers that are longer duration assets.
And besides this Fitch downgrade, a lot of this movement, especially with tech and growth corners of the market this week, were really driven after the U.S. Treasury did boost its quarterly sales when it comes to those bond sales to help really finance that surge in the budget deficits, which obviously, to your point, sent bond yields higher and really pressured those stocks. What's kind of your view here as far as where you think equity markets could go in the shorter term? Because I'm kind of wondering if this was an opportunity for some people who may have bought some of these high-flying names, whether it's NVIDIA and some of these other chip stocks this year that have really taken off, to maybe sell those and potentially buy the dip later on.
Yeah, I think very much. We've had a big rally in some of those higher flying names. They were really leading the market the whole year. So there's a bit of profit taking going on. I think the key will be really is keeping the eye on that 10-year Treasury here, because they are very much linked to it. We had a situation where we had lower capped bond yields after the 2022 issue, it's really from October. And that capping has allowed some of these higher flying, longer duration assets sort of to take off. Now we're seeing that come back up. We saw a lot of the bond yield back up in May, then we saw a digestion phase, and now we're seeing a brush with the highs. So we've seen people go from the recession call and deep rate cuts to pushing out that recession call. It was never our view, but pushing it out to next year and looking for the rate cuts there. There is an inconsistency there, though. That cost of capital, the economic data is telling you the cost of capital is not biting the household sector, employment, or even housing. It's starting to reaccelerate here. So if the cost of capital is not biting, then that means interest rates, or more likely bond yields, will eventually go higher. At that point, some of those longer duration assets will come under selling pressure.
What's the pain point specifically, say, if we're looking at the 10-year? Because it is trading around right below 4.2%, highest level since November of 2022.
Yeah, I think a decisive breakout. We flirted with this a little bit and pulled back in terms of the bond yield. I think a decisive breakout, we start to blow through those levels. I think that takes us into uncharted territory again. So I think the equity investors were comfortable as long as they could sort of go from the recession camp to the soft landing camp, if you will. And so the idea being is that growth would improve and cost of capital wasn't going to be biting. That was sort of your Goldilocks or sweet spot scenario. If we go from the soft landing camp into either bond yields break up or the no landing camp, so to speak, which would push those yields up and bring out some of those rate cuts in 2024, and then yields break higher. A decisive breakout, I think, gets us back into that uncharted territory. It puts a lot of volatility back in across financial asset markets. And in that case, given that we're flirting here, our advice to our clients is to stick where you've got a bigger valuation discount and sectors that are less exposed to that higher interest rate environment. So that kind of pulls you back into tech right now and puts you back into financials and things like that.
So, I'm looking at the world interest rate probability function on the Bloomberg Terminal WIRP. It's been wrong forever, so who knows? Yeah. But I mean, kind of saying starting next year, starting to cut rates, it doesn't sound like you're in that camp.
No, I mean, we haven't been in that camp. And the problem with that camp is always seems to be 1 year out, you cut rates, that we're going to head into recession. It's easy for forecasts and people to say, well, we're normalizing interest rates. And we're not in a recession today, clearly from the data, but a year out we will be. And so they keep pushing that out. We've seen 2 years of that pushing out. At the beginning of this year, we were in rate cuts now. Right, and so we pushed that out to the beginning of next year. Now we pushed it into mostly backloaded to the second half of next year. The real issue, though, is has the cost of capital started to jeopardize the economy? So, in other words, for the rate cut cycle to occur, you have to have something that's really going to damage the economy. And right now, the data is telling you that interest rates aren't that catalyst. So, unless you're calling for a different black swan event, then there's not a case for the Fed to cut. It may be a case where inflation comes down for the Fed to go on hold, but unless you're getting weakness in the economy based on previous rate cuts, then there's no case for the cuts. And I know there's a lot of people saying that there's this hope for a soft landing, which brings down inflation enough to allow the Fed to take the pressure off. But reality is that a big chunk of that PC inflation basket is core services ex housing, and that's linked to wages. So unless you're getting a recession, there's really no hope that we're coming back down to near the 2% target.
Do you expect to see, because you were talking about value earlier, particularly some of these more cyclical corners of the market that have picked up pace since the beginning of June, whether you're looking at small caps or even just within the S&P 500, say industrials trading around records, also materials. Do you think they can basically take the baton from tech and growth that had really obviously outperformed in the first half of the year?
Yeah, I think that's largely been our bet, is that you would end up with, as long as bond yields remained seemingly calm and didn't just spike higher here, then you ended up with a situation where growth expectations have been revised up, and really the sweet spot for your longer duration, I guess your growth stocks, is when you're in sluggish or weakish recessionary growth and lower interest rates. If you're coming away from that and you're getting into a broader, better growth backdrop, it rotates back to value in general. Now, the caveat is that you'd like to have that happen in a constructive manner where it takes that baton, as you just characterized, and leads the market higher. I think that can happen as long as the bond market doesn't become disruptive. If we start to see a material spike up, say we blow through the highs and yields, and we start to see that get a run as people start to dump their treasury holdings, then I think we're going to be into a rocky period for that rotation might occur, but just not in such a constructive manner.
What do you think is the specific level for the 10-year, for instance, like around 4.5% above that, to really recalibrate tech and growth stocks?
Yeah, I think that's probably a good target. I mean, I think we're going to ultimately have to go higher before we actually get into really a growth impinging or impediment sort of area. But I think if we start to push through that, I think it was like 420, 425 was the high. We start to break decisively above, so you get to 450. I think you're going to start to see that rotation occur like we saw in 2022. You're also going to see a lot of volatility come into the index. I wouldn't want to call it a 2022, but we might get an echo effect or a taste of that. As people get into that uncharted territory, then they start to worry about growth again, or the outlook again. But I think that rotation starts to facilitate itself as we start to punch higher. So,
what are you guys doing with emerging markets?
Yeah, we like emerging Asia in particular. I mean, most of our U.S. is a very expensive market, so we've been rotating away from the United States, especially in a context of a broadening growth, better growth backdrop. A lot of our bets has been in the euro area. Okay, but we also have exposure, and that's where the earnings power is also been.
And is a euro call a valuation call?
Yeah, it's a valuation call, but you've also got relative outperformance in earnings right now. So euro area earnings are outperforming the global aggregate. So you've got some tailwinds from a value and a fundamental story. We do like emerging markets, specifically emerging Asia. We think that China reopening element should eventually help in terms of growth and earnings within the area. We also think the semiconductor cycle is getting towards a low, and we'll start to see the ebb the other way. So there's some support, which is a lot of beta to non-Chinese Asian markets. So we have a mild overweight in emerging Asia.
All right, good stuff. Philip Colmar, thanks for joining us live here in our Bloomberg Interactive Broker Studio. Philip is a managing partner and a global strategist with MRB Partners. I like the initials there, MRB. MRB Partners. Looking at the markets here, you get what I'm saying, John?
Yeah, I get it.
Okay, you got it? Okay. S&P 500 off 0.2%, but the NASDAQ got just fractionally higher, so the market's kind of fighting for some direction here. Big earnings out after the close.
Apple and
Amazon. We'll see what the tech market can do. We're going to have more coming up. But right now, let's head down to Washington, D.C. World and national news with Amy Mars.
All right, thank you, Paul. Former President Donald Trump to be arraigned in Washington later today. Former President Nixon's White House counsel weighing in on these latest charges.
John Dean is known for his cover-up of the Watergate scandal and his testimony about what Richard Nixon knew and when he knew it. Dean tells Bloomberg while some may compare the two presidents, he says what Trump has done seems to be far worse.
All of Trump's behavior is so much different than Nixon's that it almost makes Nixon look good. It's quite incredible.
Dean used one historian's analogy that what Nixon did was like a lightning bug, but what Trump has done is a lightning storm that could damage democracy. Nancy Lyons, Bloomberg Radio.
Two former U.S. Treasury secretaries urged Washington policymakers to address the country's long-term fiscal challenges before they become insurmountable. Hank Paulson tells Bloomberg's Wall Street Week that the economic trajectory is concerning.
We're a rich country, and we've got time to deal with it, but we need to do some things in the next few years to change that trajectory.
Paulson and Timothy Geithner are co-chairs of the Aspen Economic Strategy Group, which is convening a conference this week. Seven-time Super Bowl champion Tom Brady investing in championship club Birmingham City as a minority owner, along with his friend, hedge fund manager Tom Wagner of Knighthead Capital. Wagner tells Bloomberg Surveillance Brady's role is more than just branding.
He is not here for promotional purposes. Tom will chair our advisory board. He will have a significant role in health, wellness, nutrition, effectively human sustainability, and will play a role in how we think about player interaction.
Wagner and Brady purchased a 45% stake in the club last month. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Amy Morris. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. After yesterday's more than 2% decline for the NASDAQ 100, the index is now crossed higher. Not by much. Seems to be tracing rates. Early jump in the 10-year yield, easing just a hair. In the NASDAQ, NVIDIA shares, they're doing some of the heavy lifting. That's up 1.4%. The Advanced Micro Devices advancing close to 4%. And ahead of the earnings, shares of Amazon, they're higher. Among the economic reports today, the U.S. service sector, that's the biggest part of the U.S. economy. The activity there expanding at a more moderate pace. Chief U.S. economist Tom Porcelli at PGIM says the Fed may be not too far away from trying to actually stimulate the economy.
We can still see a scenario where the Fed actually is cutting rates, sort of sooner than later. I mean, it's not necessarily this year idea, but I can see a scenario where the labor backdrop is slowly deteriorating, which it is right now.
Right now, the NASDAQ 100 4 points higher. The S&P 500 down 7 points. That's a decline of 0.2%. And the Dow Jones Industrial Average right now, that's 31 points lower. That's down 0.1%. 10-year yield is 9 basis points higher. Right now, that's at 4.17. Some important news from PepsiCo.
Let's hear
it. Maker of Fritos.
I love Fritos.
August, in celebration of the USA Mullet Championships, Fritos offering fans the iconic hairstyle. You can get a mullet cut free if you qualify.
All right.
Fritos offering mullet cuts because, yes, this is the USA Mullet Championships taking place. Where else? Plano, Texas.
Oh, come on.
The home of.
Where the mullet really never went out of style.
And the home of. It's not the home of Pepsi.
I feel like...
Is it? No, Plano, Texas. I think they were up in
I'm hitting the DES.
My homeland.
I'm hitting the DES.
Was that a cheap shot,
Yeah.
John Tucker, at me?
Yeah.
I found out something interesting when you briefly stepped away, Paul, that John Tucker has met the boss.
Of course he has.
No, he lives down the street. Actually, a long story, but yeah.
They're neighbors.
Sort of.
Different.
But anyway, the birth of my daughter, Bruce had something to do with that. I was telling Jess because he ran into my wife who was with my son at the time, who's the cutest baby on earth. And she said, no, that's it for me. And Bruce convinced her, no, you got to have another one. That's selfish, et cetera, so forth. So
really,
that's how.
Nice.
What a great story.
Say Jersey Shore, things happen.
Bruce Springsteen.
I blame Bruce for that.
So enthused with that, John Tucker.
Yeah, right.
Thank you, JT. We appreciate it. And Paul, obviously we've talked so much about Apple, Amazon after the bell. So Apple, it's ticker symbol AAPL. And then if you're looking at Amazon, ticker symbol AMZN. Both of these stocks up around 50%. We were just speaking with a batch duo of Bloomberg Intelligence analysts earlier, talking about how when you have two stocks like that up so much, you really have to justify those types of earnings. And clearly, if you're looking at Apple, really projected to report a third consecutive decline in revenue as those iPhone, iPad, and Mac sales fall year over year. And then if you're looking on the other side of that with Amazon, the strength when it comes to its streaming and advertising could be offset by slowing consumer and enterprise spending. And that's some data coming out of your buddies over at Bloomberg Intelligence.
Yeah, as I think about the Apple Store, I mean, I don't know. My phone is, I think it's the 11 or something like that. I could check.
I think I have the 13.
It is by no means top of the, the most recent kind of thing here.
I kept the 6 for so long until my phone company forced me to upgrade.
Okay, this is an iPhone 11. I just checked. So now the question is, when do you upgrade? Remember back in the day we used to upgrade almost every year, every 2 years.
I was one of those that just didn't. I just kept it going as long as it could possibly go.
Well, now it's longer. It's a longer term, but that's okay because they have so many other products, the wearables, and categories that didn't even exist before. So that is kind of there, but it just doesn't seem like we have that that new phone. I gotta have it, and that's one of the challenges for the Apple stock. Not that it needs any challenges, because you said it's up 50% this year, but people say there's just nothing out there that's going to move the needle in terms of. But I think when you listen to the Dan Ives of the world, the supporters, they say that's not the story anymore. The story is we've got 2 billion of these Apple units out there, whatever they are, and you generate revenue off of that installed base, whether it's the services business, which continues to put up good growth.
Definitely does. That iPhone 15, everybody's excited to hear more about that, especially what
I might take a look
Tim
at that.
Cook. I mean, you never know with the types of gadgets. I might have to end up upgrading again too. But Apple has also asked its suppliers to keep iPhone shipments flat year over year, so it's been trying to contend with this waning demand for electronics, though it may still raise some prices for its Pro models. So that's another big one, obviously looking after the bell today. But then also looking a little bit further out, we do have Disney next week, Paul.
Yeah.
And I know you love when it comes to the media companies with your expertise in covering them, obviously on the sell side for many years. But when you look at that stock, obviously not just struggling this year, but for a few years now, how do you view as far as what's been happening with this particular company when you think of like Bob Iger coming back in at the helm, him extending this particular tenure for another few years here, how they can turn things around?
Yeah, for the broader media space in general, very, very difficult outlook. I think there's some headwinds, some longer-term headwinds, which are how do you migrate your business model from what you've grown up with over the last 50 years, which is pay TV subscribers paying you for your cable networks, paying you for your movies that you put out and all that type of stuff, which was reliable subscription revenue from the cable companies, pretty reliable and growing advertising, to now a new model, which is a streaming-based model where you sacrifice and give up a lot of those economics from the old model. So you transition from the old model to the new streaming model. It is proving to be, and will continue to prove to be, a very bumpy ride. And that's kind of right where the industry is right now. And so for a lot of investors, that makes it uninvestable. And that's not Disney. That's just the media space in general. People that I know that have owned these names for decades don't own them and won't own them until they have a better idea how that transition will take place and who the winners and losers are. That's just the industry backdrop. For Disney, they've got all those issues in spades because they're the biggest movie studio in Hollywood. They put out the best content, but they've got some businesses like ESPN. You're just not sure what to do with that business, which was your cash cow for decades, and now it's because of that cord cutting, it's become a real albatross. What do you do with it? Do you sell it? Do you partner up with some?
The million-dollar question.
Yeah, so it's just a big, big issue.
So August 9th, that's next Wednesday. So after the close, that is when Disney is reporting. And if you look at the terminal in here, the Disney options imply about a 5.6% share move post those earnings. And in 7 of the past 8 earnings reports and those calls, the company's stock price moved more after the announcement than the implied options moved.
Interesting.
So that's going to be interesting, especially just given where its stock has been at. Relatively hasn't done too much this year, but those implied moves versus the price action in those previous earnings reports is going to be key to see how that reaction could potentially be by investors after the bell next Wednesday.
Yeah, but I think what a lot of the bulls on Disney, they hang their hat on is that Disney has just the best assets. They have the best film studio in Hollywood. They have the best theme park business, which is a business that everybody on Wall Street loves, and these media companies like Comcast would like to have more of them. Obviously, Disney's got the best, but the question here is just simply, and then they've got a management succession challenge with Bob Iger. He's just re-upped his contract for another 2 years, so that buys a little bit of time. But there really is a management succession issue at Disney as well. So when the company has their earnings call, they're going to have to really be clear about a lot of these issues, and I think the street really wants to hear, as they do from other media companies, the path to profitability of this transition from the traditional model to what is a new streaming model.
What we did hear from their results back in May, they actually posted a decline in those streaming subscribers. If you look at its stock, that's ticker symbol DIS, it's down only about 0.5% today, but if you look year to date, it's down about 1.2%, so really hasn't done too much this year.
Dramatic underperformance of the S&P 500, and again, that just kind of, more than the Disney issues specifically, they're really just more industry-wide issues, so we'll have to see. So the companies have some explaining to do.
I feel like, to your point, parks are really shining when it comes to Disney, but those traditional TV businesses are the ones that continue to see those declines.
Yep, and they have a lot of exposure to China. They have Shanghai Disney, which was a a $5 billion investment, and presumably with China reopening, that'll be good news for Shanghai Disney, which is a big business for them. So we'll follow up all those companies, all those earnings. More coming up today. This is Bloomberg. Let's get some company news right now with Steve Rappaport.
Paul Hasbro has a buyer for its TV business. More on that from Bloomberg's Gina Cervetti.
Steve, Lionsgate Entertainment agreed to buy the E1 Film and TV studio from the toy maker for $375 million in cash, plus the assumption of loans. Hasbro says it will use proceeds from the sale, valued at $500 million, including the loans, to wipe out at least $400 million of debt by the end of the year, confirming an earlier report by Bloomberg. E1 accounted for about 14% of Hasbro's revenue in 2022. Hasbro and Lionsgate expect to close the deal by the end of the year, pending regulatory approval. Steve?
Thanks, Gina. Shares of Hasbro up more than 1.5%. Lionsgate stock down more than 2.5%. They expected prices to keep soaring in the post-pandemic travel boom. Now JetBlue, Alaska Air, and other U.S. carriers are slashing fares to boost domestic travel. So what went wrong? Well, Americans are showing an increased appetite to head abroad as other countries loosen COVID-19 restrictions. And at the same time, many domestic-focused airlines are facing higher costs from new labor deals, flight disruptions, and inflation. The companies are hoping domestic ticket sales will pick up again in a few months, with holidays encouraging people to travel closer to home. It was the Macho Man's spicy snack of choice.
Get a little excitement? Step into a Slim Jim.
Slim Jim owner Conagra Brands is signing a multi-event deal with World Wrestling Entertainment that will make Slim Jim wrestling's biggest corporate sponsor. The partnership will debut at WWE's SummerSlam event this weekend. Those are the company stories we're following this hour. I'm Steve Rappaport, and this is Bloomberg.
You're listening to Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, Jess Metton and Paul Sweeney here in our Bloomberg Interactive Broker Studio in New York City. Looking at the markets here, just not much movement here on the S&P and Dow, pretty much unchanged. A little bit of a lift here to NASDAQ. The actions in the yield space, 10-year Treasury up 11 basis points, 4.19%. On your 10-year, the 2 years at up about 1 basis point, 4.89%. So some steepening of that yield curve. Gold resuming its move higher, up 2.3% today, $81.31 for WTI crude oil. Even Bitcoin's getting a lift. Tom's not here, so we'll call out Bitcoin. It's up 0.4%, 29,242 for that cryptocurrency. Right now, let's get world and national news down to Washington, D.C. with Amy Morris.
All right, thank you, Paul. In about 4 hours, former President Donald Trump is expected in a Washington federal courtroom to face new charges that he conspired to obstruct the 2020 presidential election. The former president is also pushing for a change of venue. He says he would rather have the trial in West Virginia than in Washington, D.C. Today's hearing is set for 4 p.m. Eastern Time. Republican donors who oppose Trump might be making a mistake by spreading cash across the GOP field, not focusing on just one candidate who could defeat Trump for the nomination, which creates a dream scenario for the former president, splitting that money and support from influential voices among the roughly dozen candidates in the race. Party insiders worry Trump's mounting legal problems will make it impossible for him to beat President Biden. And President Biden is dealing with fallout from actions by his son, Hunter. A judge has unsealed the proposed plea deal between Hunter Biden and prosecutors, showing that Hunter Biden earned more than $4 million from a Ukrainian energy company, a Chinese private equity firm, and other sources. That's over the course of 2 years, where the agreement says he descended deeper into substance abuse. This is Tony Bennett Day. Bloomberg's Michael Barr has more.
Why haven't you seen it?
He's the kind of singer where you would sit on your couch, curl up with a beverage on the rocks, and relax.
Body and soul.
Tony Bennett, the legendary singer from Queens, would have celebrated his 97th birthday today.
I left my heart.
Bennett died on July 21st, just shy of his birthday. The U.S. Senate introduced a resolution led by New York's Chuck Schumer to declare August 3rd as a day dedicated to Bennett, who served in World War II. In New York, Michael Barr, Bloomberg Radio.
All right, thank you, Michael. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Amy Morris, and this is Bloomberg. Paul and Jess.
Thank you, Amy. We appreciate it. Jess Mitten, Paul Sweeney here in the Bloomberg Interactive Broker Studio. And I'm taking a look, Paul, at this particular story on the terminal. The headline, the Hamptons wants to borrow more money as wealthy linger longer. So this is taking a look at how East Hampton is joining a list of wealthy U.S. tourist destinations that have sold debt this summer. So that includes Bar Harbor, Maine, pricing about $50 million this week, while in July, Newport Beach, California, issued around $26 million. And then, of course, Miami Beach in Florida did offer about $97 million.
It's interesting. So the analyst at Moody's is saying, as it relates to the Hamptons, people come earlier and stay later, and a larger percentage of people are now making this their full-time home. So they need to invest. They're going to refinance some of their debt with this deal, but they're also going to use some of the proceeds to help compliance with the Americans with Disability Act for a lot of their facilities. They're going to build new ball fields, spruce up the Montauk Playhouse, and improve town's ability to efficiently provide necessary services. So it's interesting. Joe Mysak will talk to him tomorrow because it's Municipal Bond Friday here. But we've seen this before, as you mentioned, some other places that are seeing increased use of their time post-pandemic.
Right.
We need to invest a little bit back in those towns.
Is that enough to pull you out away from the New Jersey shore?
Never.
Are you going to stick there?
Never.
No,
the Hamptons
not go
are
to
great.
East Hampton?
And go have fun out there, kids. And the Hampton Jitney's right across the street from the Bloomberg headquarters, and in these summer days,
there you go.
When I'm leaving work, people are lined up to take that.
They're ready. They're ready to get out of here.
They're all fired up. So good for them. Have fun out there in the Hamptons. We're raising some money here, and that'll be good for all those folks out there. We'll have more coming back. This is Bloomberg.
This is Bloomberg Markets
with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe the central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this thing called AI?
This is Bloomberg Markets
with Paul Sweeney
on Bloomberg Radio.
All right, coming up in this hour, lots of good stuff. We're going to start off by looking at Amazon, not from the earnings perspective, but from the Federal Trade Commission. They have an antitrust suit that they are looking to enforce here. So we're going to take a look at that with Jen Reese. She follows all that stuff for Bloomberg Intelligence. And then Geetha Ranganathan, she's the U.S. media analyst with Bloomberg Intelligence. We're going to preview a lot of those media earnings coming up. We also had a little deal in the space. Lionsgate Studios is buying another studio. So we'll take a look at that one. Our C-suite conversation of the day. Remember those FICO scores that we all have to deal with every day? There's actually a company behind that, and that company's name is Fair Isaac Corporation. Its symbol's FICO, not surprised. Stock is ripping, up 45% year to date. It's one of those tech names that's really benefiting. So we're going to get the CEO on to talk about what's happening at that company. But let's kick it all off with Charlie Pellet.
Paul Sweeney, lots of moving parts to today's markets, and we've got you covered. The Dow, the S&P, NASDAQ, all in the red right now. Treasuries deepening a sell-off, driving the 10-year yield to a 9-month high. Equities are slumping as investors grow increasingly worried about rising borrowing costs. NASDAQ, though, has been swinging between gains and losses. We begin there. NASDAQ down 3 points now, little change, down less than 0.1%. The S&P 500 index just above 4,500, 4,503 right now, down 9 points, a drop there of 0.2% off session lows. The Dow slumping 41 points, down by 0.1%. That 10-year yield, 4.18% right now, with the 2-year that's yielding 4.89%. Spot gold, little changed at $19.33 the ounce, down less than 0.1%. West Texas Intermediate crude oil rallying 2.2%, 81.26 a barrel for WTI. As we mentioned, earnings coming up after the bell include Amazon and Apple. Anurag Rana is a senior tech analyst with Bloomberg Intelligence, and he was our guest this morning right here on Bloomberg Markets.
This is pretty much a very boring quarter for Apple because the next version of the iPhone is usually launched in September and then gets released for the seasonal, holiday quarter, and that's really the big push for them. And that's really what we are trying to listen today is, how's the services business doing? Do we see any rebound over there in that growth rate? And the second part is the supply chain okay when we do get the new iPhone and the orders come in, that they have the capacity to fulfill those orders, something which had a problem last year.
And you can hear more of that conversation on the Bloomberg Tape podcast. You can download it wherever you get your podcasts. Apple and Amazon, by the way, have been critical to the S&P 500's advance this year. Clorox, which makes Glad trash bags and Hidden Valley salad dressings, reported sales and profit that handily topped analyst projections. Also, MGM Resort shares, they are trading lower after the casino and resort operators' performance in Las Vegas and its regional operations fell short of what analysts said they were expecting. Again, recapping, NASDAQ just turning higher once again, up by 3 points. Little change for the S&P, down 8, now down 0.2%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. Let's see what's happening with some of the individual names out there in the marketplace. We welcome Bailey Lipschultz. He covers the markets for Bloomberg News, joining us here in our Bloomberg Interactive Broker Studio. Bailey, what are you looking at?
Yeah, looking at a lot of weakness across airline booking and hotel stocks after earnings showed that the summer travel boom is moderating and maybe people are staying closer to home and not traveling as much. This comes after hotel operator Marriott Vacations cut its adjusted earnings guidance for the year. That's weighing on peer Hilton Grand Vacations and airlines, which we've really talked about at length following Spirit lower after the low-cost carrier reported 2Q earnings that trailed expectations. Again, you got to keep in mind when you look at the top 10 performers in the S&P 500 this year. Yes, you have NVIDIA and Meta, but you also have Carnival, Royal Caribbean, and a number of other stocks geared towards some of that revenge spending. But when you have a stock like Expedia reporting second quarter revenue that missed expectations, also signaling the potential slowdown, a lot of these companies that had been caught up in that revenge spending, revenge trade, trading in the red and trading down so far this morning.
I have to ask you about the wild ride that Tupperware has been on, because Bailey, as you know, does all things memes as well, in addition to SPACs and some of the macro too for our equities team. So this is ticker symbol TUP. It's up another 7% today, but at a certain point coming into this week, there was a 2-week span where it had gained, around 800%?
Yeah, just around 800% on that intraday high on Tuesday. This is a stock that, like many other heavily shorted, beaten down companies, potentially teetering on the cusp of bankruptcy, got caught up in this meme trade, attracted retail traders as well as Wall Street pros. Still a thing, and it's something that Dan Loeb called out in his quarterly letter, basically saying that they're addressing their short positions based on not going unprotected against individual companies, because you see Tupperware ripping higher, you've seen Nikola and Carvana and some of those beaten down stocks. I wouldn't necessarily call them meme stocks, but being caught up and seeing triple-digit rallies. Even Yellow, the trucker company that was basically seems to be preparing for bankruptcy, ticker YELL, was trading at 57 cents last Thursday. Now it's north of 425. So a lot of these stocks having the propensity on both sides to see sharp rips higher and lower.
I mean, who's doing this stuff? Is it still just the retail folks? I thought that was
Can
just
the retail
kind of
move it that much?
a pandemic thing.
Right.
No, I don't think, again, you look back at what we saw in 2021, GameStop, AMC in particular, a couple other companies, those were predominantly driven by retail flows. Out of the money, short-dated call options, helping create gamma squeezes. These look like
gamma squeeze?
You basically buy call options. It forces the kind of buying of more stock, which then inherently buys more shares. Basically, just one easy way to keep getting shares traded. But when you look at the volumes, you look at a stock like Rite Aid, I wouldn't call it a meme stock. 57 million shares, a record traded yesterday. Stock jumped 30% at 1.68%. So this is a bit of retail, but does have the flavors of some real money from Wall Street getting in on this action. Because again, I don't think retail was trading north of $100 million of just Rite Aid at the flip of a switch.
Tupperware, 48 million shares today.
Wild. What else are when you look at the Vonda data for the flows kind of more broadly, what is it telling you about retail traders at this point and what they're buying and what they're selling?
I mean, they're still for the most part buying their favorites, Apple, Tesla, the SPY, QQQ ETF. When we wrote a story earlier in the week at Tupperware, about $15 million in net purchases over a week and a half, which is strong, was a record flow for the individual company, but you're comparing that to $300 million in a day for Tesla. So it's not the kind of insane buying that we saw back in January 2021, where
the peak euphoria, the FOMO.
Exactly, and when you saw people with license plates that said AMC to the moon, you had people celebrating with bottle service at day clubs.
Was that you, Paul? Did you have the license plates on the BMW?
Oh, please. Unbelievable. So I'm just looking at this. I mean, some of these meme stocks, when I see them there, obviously, like for a lot of investors or a lot of observers of the market, it feels like, oh, this could be one of those things that's just a top to the market. We're getting, kind of a little bit of that frenzy out there.
Actually, your buddies over at Bloomberg Intelligence, Christopher Kane, he has that meme stock factor. And so what he was looking at, it picked up in June, was flat in July, but to him it was signaling more that if you're looking at the Russell 1000, more broader large cap stocks, typically it bodes more well for the broader sector as far as risk taking, but not at the excessive FOMO in his opinion just yet. But BI data there.
Yeah, well, the one thing, I mean, we keep an eye on the Roundhill Meme ETF, which is ticker is meme, and it's a big debate, really, across retail traders and even Wall Street on what is a meme stock. You look at Carvana up over 1,000% this year. Is that a meme stock, or is that a Wall Street hedge fund Tiger Cub favorite that just happened to be the right mix of everything to get buying?
So there's an ETF for memes?
There is an ETF for memes. Roundhill, they're behind Nerd. They're behind a sports betting one. Wow. So all the thematic ETFs.
Man, we got to keep this guy close.
We have
to. He knows all that stuff. All right, Bailey, thanks so much for joining us. Bailey Lipschultz giving us the market roundup with a little bit of meme stuff thrown in there. Let's bring in our next guest, Jennifer Reese. She's a senior litigation analyst focusing on antitrust at Bloomberg Intelligence. She joins us via Zoom. And she's got some work out because our good friends at Amazon, who again report earnings after the close, they've got a little bit of an issue with the Federal Trade Commission here. Jen, thanks so much for joining us here. Can you just summarize what the FTC is doing with Amazon right now?
Sure. Thanks so much for having me. I mean, this has been so anticipated. I feel like I've been writing about this coming lawsuit against Amazon by the FTC for about 2 years. And, the reason, Paul, why we all knew this is because the current chair of the FTC, Lena Khan, has been a vocal Amazon foe. I mean, in fact, she published a big paper where she basically described all the ways that she thinks Amazon is a monopolist and behaves in an anti-competitive manner, and it damages competition and it's bad for consumers. And so I think there was an expectation that once she came into the FTC, she would launch an investigation. In fact, it was launched before she even started, I should say. But that investigation would culminate in a lawsuit. And now we're seeing some news that this lawsuit's coming possibly in August. It'll be for monopolization, most likely. Which is, one half of sort of the antitrust world. The other half is price fixing. But this is going to be about Amazon's conduct. And I do think it's going to be aggressive and wide ranging and probably ask a judge to try to break up parts of the company's business.
Really?
Do we have any sort of scope of the timetable and how long this could take?
You know what? It's going to take a long time. And it's funny because there will be a lot of news. And honestly, then we're going to hear nothing because these take so long. I mean, the complaint will come out. It'll get started. And then what happens is the companies go through what's called a motion to dismiss process, which could take up to a year, where they try to at least get some of the complaints, some of the claims in the complaint thrown out. And then they get into the discovery phase, which can go a year or more before they really get into sort of the nuts and bolts of the litigation, summary judgment, and trial. So honestly, we're looking at 2 years, probably more, could be 3 years before there's even a first decision, which could then be appealed.
So, Jen, are they looking at the retail side of Amazon as opposed to the web services side, or are they looking at it in its entirety? Where's really the focus here, and what are some of the concerns that the FTC has?
I think the main focus is going to be about the platform and the way they treat third-party sellers in the platform. Okay. They could get into cloud too, but I think this is mostly about the platform, right? And about first, whether they have provisions in contracts with third-party sellers that prevent those third-party sellers from offering their product outside of Amazon at a lower price, that Amazon has to get the best price. This is a pretty common, it's called the most favored nations clause, and it's actually pretty commonly used in business. But in this case, because it is more expensive for the seller to sell on Amazon than, let's say, its own website or maybe on Etsy, what the consumers and some state attorney generals that have already sued about this have said is that it causes prices to go up on Amazon and on websites outside Amazon. I think that's probably going to be in there, Paul. And then I also think some allegation that the third-party sellers on the site are either punished or rewarded for using other Amazon services, like their fulfillment services or like advertising on Amazon, so that they're sort of bundling or tying these products together. And that to really get good sales on the website, you're sort of forced to buy other services. I think that'll be in there too. Cloud might be as well, but it might be a little premature. I think the FTC has an open cloud industry investigation, and they're looking at Amazon as part of that. That could be a new complaint that comes down the road, or that could be part of this.
What precedents has been set, if any, for other companies in a particular situation like this?
That's a really good question, because there are very few precedents, honestly. There have been very few over the years lawsuits brought by an enforcer, the Department of Justice or the Federal Trade Commission, against a company for monopolization. And the really big one, the one we kind of think of as the Bible, was a case the Department of Justice brought against Microsoft back in the 1990s, and it ultimately resolved, I think it's something like 2000 or 2001. Now, having said that, the FTC did sue Qualcomm for monopolization just a few years ago, and they lost over the way Qualcomm was licensing its chips. It wasn't as big a case as Microsoft. It didn't get quite as much press, and they weren't seeking to have Qualcomm broken up, which is kind of a big deal. So there's very little, there are private suits, but there really is very little precedent, and mostly there's not a lot of precedent with plaintiffs winning these kinds of cases. They can win. They can win. It's hard.
So what's the consensus here among legal experts like yourself on this antitrust thing? What's reasonable outlook for the FTC here at this point?
You know, Paul, this is how I think about this suit. I think there's a lot of risk because it won't settle. The FTC is not going to settle. That's the first thing. And secondly, they're trying to get a breakup. And you know what? You go into court asking for that. If everything falls into place, you get the right judge. Maybe you get something like that. I think it would be overturned on appeal. I think some of these allegations actually might have merit. For instance, perhaps the use of the most favored nation clauses, or perhaps even, you know, if it's true that they sort of force sellers in order to really get sales in the platform to also buy their fulfillment services or advertise on the site, you know, that one might have some merit too in terms of an antitrust violation. But at the end of the day, when you ask what are the remedies for these violations, a judge is really told from the Microsoft suit, from that big precedent, that you use the remedy that's the least drastic that's going to fix the problem. And in my mind, there are a lot of remedies out there that are behavioral in nature, that are much less drastic than structural, that would fix the problem. You know, for instance, a firewall, or for instance, just saying you can't discriminate against sellers anymore based on which of their products they use or buy. And in fact, those kinds of remedies are already being used in the UK and in Europe. The UK and Europe have the same complaints about Amazon, and Amazon is settling those cases and offering up exactly those kinds of remedies. And those regulators, who are absolutely as aggressive as the US FTC, are accepting those remedies. So when I think about this, I think about way down the road, even if the FTC wins pieces of it, they won't win all of it, the remedy is likely not to be particularly substantial or impactful to the company. That's kind of how I view the long-term outlook, Paul.
And that's kind of, I think, the market views it, because, again, the stock's up 50% year to date, but we'll see.
Right.
I'm actually curious, what's the likelihood that the FTC would settle?
I think it's very, very low. This is not a settling FTC. They have expressed that overtly. They're not interested in settling, particularly mergers. And this is a big deal. This is their case. This is the one Lena Khan wants to make her name on. She is absolutely gunning for Amazon, I think, in the same way that the Department of Justice is kind of gunning for Google. And when you're really going all out and you really want to try to get that breakup, I don't think you're going to settle.
Hey, Jen, thanks so much for bringing this to our attention. Amazon, big story here. It's going to be a long-term story, as they tend to be on the legal side. Jen will stay on top of it, as we will. Jen Rhee, senior litigation analyst covering antitrust for Bloomberg Intelligence. Amazon and the FTC kind of butting heads, so we'll see how that plays out. Again, Amazon after the close. We'll even see if that's even an issue that's brought up on the call that I've been to see if anybody raises it.
Also, calls from those and questions from analysts, but looking at it, ticker symbol AMZN, up about 0.3% today, but if you look for this year, up 53%. Paul.
Yep, absolutely. So we'll stay on top of that. Just looking at gold here, pretty much unchanged here at $1,935 an ounce. WTI crude oil up 2.25%, $81.28. We'll have more coming up. This is Bloomberg. Let's get some company news right now with Steve Rappaport.
Paul, it's decision time for hundreds of thousands of UPS employees. Workers represented by the Teamsters Union begin voting today on a new contract. Bloomberg's Erica Herskowitz reports.
Those employees have a lot more power over the fate of the deal, as Teamsters boss Sean O'Brien imposed limits on his own power to decide such things back in 2021. So he can't impose a contract if more than half of the workers reject it. And some are on that path, as the organizer of a Veto No campaign says O'Brien overpromised and underdelivered.
Thanks, Erica. Shares of UPS are up less than 0.5%. Is the post-pandemic travel boom starting to bust? More on that from Bloomberg's Joan Doniger.
There is more evidence of a travel slump. Expedia reported revenue for last quarter that came up short of expectations. It rose only 6%. Analysts thought there would be more flight reservations, hotel stays, car rentals, activities, and vacation rentals across Expedia's platforms. International travel's been surging, but domestic trips have slowed a bit. Airlines are starting to cut those fares when they didn't expect to have to.
Thanks, Joan. Other factors for domestic carriers slashing prices include higher costs from labor deals, flight disruptions, and, of course, inflation. Warren Buffett isn't fretting over Fitch's U.S. credit rating downgrade. The Berkshire Hathaway boss tells CNBC there are some things people shouldn't worry about. This is one. Bank of America's CEO Brian Moynihan also was unfazed. He told Bloomberg's David Weston the move is a non-event. And those are the company stories we're following this hour. I'm Steve Rappaport. This is Bloomberg. Stay tuned for more Bloomberg Markets with Paul Sweeney. That's coming up right after this on Bloomberg Radio.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 12:21 on Wall Street. We do check markets all day long here at Bloomberg. A turnaround for the Dow, now higher by 1 point. Little changed. We have got NASDAQ up 14, a gain there of 0.1%. S&P 500 index on a busy day for corporate news does remain lower, down by about 4 points now, a drop of just about 0.1%. Russell 2000 index of small cap shares down 0.2%. The NASDAQ 100 index higher now by 0.1%. Bitcoin at 29,230, up by 0.4%. The 10-year yield 4.17%. Now we've got the 2-year yielding 4.88%. Spot gold little changed, up 60 cents the ounce to $19.35. West Texas Intermediate crude back above $81 a barrel, up now by 2.4% to $81.39 a barrel. Oil and natural gas producer ConocoPhillips has agreed to a long-term deal to buy liquefied natural gas from an export terminal being developed along Mexico's west coast. And this morning, Conoco reported second quarter adjusted earnings per share that did fall short of Wall Street expectations. Tesla's China deliveries slumped in July to the lowest level this year as the electric vehicle maker struggles to attract buyers despite price cuts and other incentives. Tesla shares, they're up today by about 0.8%. Again, recapping the Dow just turning negative, down 2 points, little change there. S&P down 4, NASDAQ down 14, and of course, big earnings after the close of trading today. Apple down now by 0.4%, Amazon higher by 0.4%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Thank you, Charlie. We appreciate it. Jess Minton and Paul Sweeney here in the Bloomberg Interactive Broker Studio. And Paul, you and I were just talking about Disney earlier, but then also looking at potentially that company rethinking its strategy after cinemas did get a reprieve in July from weeks of these disappointing film attendances with, obviously, when you think about Barbie, Oppenheimer, not sure if you saw both of them or not, Paul, but I want to bring in our next guest to break this down, as well as some other news. So Geetha Raghunathan, who's one of our great strategists here at Bloomberg Intelligence, U.S. media analyst at the firm, joining us on Zoom to discuss that. But also first, I wanted to start off with what's happening with Lionsgate buying E1 and the news there. So Hasbro actually sold Entertainment One Film and its TV unit to Lionsgate for $375 million in cash, plus the assumption of its loans. Geetha, walk us through this details when it comes to this deal.
Yeah, absolutely. So Lionsgate, as you just pointed out, bought that. It's basically some film and TV production capabilities that they have brought from Entertainment One. And of course, Entertainment One is really well known for, all of its preschool brands, right? Whether it was Peppa Pig or PJ Masks, My Little Pony. But, none of those brands have been sold to Lionsgate. So this is really more, film and TV production, especially it gives them a lot of capacity to make unscripted content. And if you kind of think about Lionsgate, I mean, this is one of the few independent studios that is still available kind of in Hollywood. If you look at all of the other studios, they're part of, these bigger conglomerates, whether it's Warner or Disney or Paramount. So this is a company that has, obviously they have a great library, over 17,000 titles. They come up with some, they have some pretty good franchises, whether it's the Hunger Games or the Twilight or even John Wick. So they do have some good franchises, and they could be a great add-on for, a huge tech company, maybe an Apple or an Amazon or a Google. And what they're trying to do is to really kind of find more value in their assets. So they currently have a film studio, and they also have a cable network division called Stars. But they are in the process of separating those two businesses so that they can kind of unlock value. And I think what they're trying to do here is kind of really beef up their studio assets so that it could fetch them premium valuation when they decide to sell.
All right, Geetha, we're about to kick off some big earnings for the media companies. And actually today we had Warner Brothers Discovery. They took their guidance down a little bit, but talk to us about Warner Brothers Discovery, because that's one of the leading media companies now with David Zaslav as CEO. It's right up there, trying to vie for some leadership position in the global media space. What did we learn today from Warner Brothers Discovery?
Yeah, I'm actually a little bit surprised, Paul, at the reaction. I think it's almost a little bit of an overreaction because the results that they reported were stellar. So the one metric I think that everybody is focused on these days in the media world is free cash flow. And they absolutely blew it out of the water. So we were expecting about $900 million to about $1 billion in free cash flow for the second quarter. They came in at $1.7 billion.
Wow.
Of course, they got a little bit of a boost from the writer's strike. They did say that, about $100 million boost. And they do expect to see a similar level of free cash flow again in 3Q. So as far as, profiTability metrics are concerned, free cash flow is concerned, I think they it was absolutely...
Includes that flagship Disney Plus streaming service, actually suffered a loss of more than $650 million. What are you looking ahead to for the outlook when it comes to Disney's report?
Yes, and Disney, I don't think it's going to be so much about, the quarterly metrics as more about strategic direction. I don't think this quarter is really going to do anything in terms of, the numbers itself. I think it's really going to be more about what Bob Iger says about what he's planning for ESPN. And there's been so much of speculation about what he's planning to get to streaming profitability. You brought that $650 million loss number. Actually, their streaming losses are expected to go up a little bit for this quarter, but that's not really the point. The point is, what are they going to do with the linear TV assets? What are their plans, for Hulu? So it's really more strategic direction that we're kind of going to be looking for when Disney reports next week.
So how does the whole Barbenheimer situation also affect their strategy? Have to ask.
Yeah, so I think what it tells us is that Disney's content engine is clearly broken, right? Because we can talk about, maybe, box office demand kind of flagging a little bit, but it doesn't really look that way. I mean, if you look at the movies, the top movies this year, whether it was a Super Mario, that came out from Universal, you look at, obviously Barbie, Oppenheimer, all of them doing really, really well. So it really looks like the Disney franchises have gotten tired, right? Whether it's Marvel, whether it's, Star Wars, and their animation studio has really had a string of misfires. The leading animation studio today is, surprisingly, it is Universal.
Really?
They've had a string of hits. They're doing really, really well. So definitely there has to be a huge reset in the film division, and it's going to be interesting to see what, Mr. Iger has to say when they report.
I mean, I never thought I'd hear those words, Geetha, because I thought their movie strategy was just set forever, just mining all the films out of Marvel and Pixar and all those types of things. But boy, if that's in fact the case, that's really big for this stock, and it really puts a pressure on Bob Iger. It's interesting. Has a company kind of admitted that, or is that just kind of a conservative take?
I think they have somewhat admitted to it, which is why we're kind of, they kind of had a pause on some of their Star Wars properties. They're delaying some of their, other releases. So I think definitely, Bob Iger is taking a hard look. But again, Paul, as you very well know, content production takes a while. I mean, if you want to make a good film, it's going to take 3 to 4 to 5 years. So this, he has to be in this for the long haul, and that kind of explains why, he extended his contract as well. I think it totally makes sense. But definitely, clearly something has to happen on the content front to kind of reinvigorate, re-energize all of these franchises.
What are the companies saying? I know Jess brought it up earlier, but these strikes, the writer strike and the actor strike, I mean, they got to get resolved like now, but I don't hear any sense of compromise from either side here.
Yeah, I mean, again, as you had mentioned earlier, so the first thing David Zaslav said on the call today was, we need to get these strikes sorted out. That's what Netflix said as well. So, obviously it is of paramount importance. They need to get it done. But again, haven't really heard anything, just as you said. As of right now, the only good thing that it's doing for all of these companies is it's really boosting their free cash flow numbers. But come 2024, it's going to be a bloodbath, especially when you have a complete, pause in terms of the content pipeline.
Do you think that Barbenheimer can crush box office for a third week in a row?
I absolutely think so. I mean, there are going to be a few new films, obviously, this weekend. Teenage Mutant Ninja Turtles, Meg 2. Again, don't stand a chance at all. By the end of this week, and Zaslav actually mentioned this in the call, they expect Barbie to cross $1 billion at the global box office. So it's just been spectacular.
What are the theater operators saying about the movie business in the future?
So they are actually, so obviously this has really played well for, the theater operators. We've seen kind of box office estimates go up a little bit. Of course, there are clouds on the horizon, Paul, with those strikes. So again, it's a little bit iffy still. But I think in general, the sentiment seems to be good. I think the one thing that comes out of the Barbie success is that people really want to go see original movies. They want to see something new. They want to see something fresh. And if you make good content, people will definitely go.
All right, Geetha, thanks so much once again for joining us, bringing us up to date on all things going on in the global media space. Geetha Raghunathan, she is the senior media analyst. He covers a lot more of the media at Bloomberg Intelligence, based down there, holding down the fort in our Princeton studio down there, down in Princeton, New Jersey. So looking at AMC Entertainment, that's one of the bigger theater names that's out there. And the stock, I don't know, it's up 20% year to date. I'm looking at Cineplex, Odeon, and other. The Cinemark is up 100%. So, but again, as Keith says, bring the good movies in, they'll come. Right now, let's head down to Washington, D.C. We'll get world and national news with Nancy Lyons, Amy Morris.
Paul.
Oh, there we go. Nancy Lyons, there we go.
Former President Trump will be appearing in federal court today in Washington, D.C. to be arraigned on charges of conspiring to overturn the 2020 presidential election. The hearing is set for 4 p.m. Washington time, when Trump will be fingerprinted and his information collected. No mugshot will be taken, though. Crowds are building outside the courthouse, and law enforcement is prepared. Tom Manger is chief of Capitol Police.
We've been working with our partners from our partner agencies here, MPD, U.S. Park, Secret Service, and Federal Protection Service. We've all been working together.
Chief Manger says Washington is used to handling crowds. As for what happens inside the courtroom today, former Watergate prosecutor Nick Ackerman tells Bloomberg the Justice Department will likely share all its findings with the Trump team.
At the arraignment, they're going to announce that they're basically producing all of the discovery immediately, including witness testimony and witness statements, which is really unprecedented. I never did that as a prosecutor.
Ackerman says this is not a complicated case, and it will likely go to trial in either January or February. You can stay tuned to Bloomberg Radio for full coverage of the arraignment. It's been just over 2 weeks since 23-year-old U.S. Army private Travis King ran across the demilitarized zone into North Korea. North Korea did acknowledge this week that Travis did cross, and they are now investigating the matter. Today, his mother spoke with ABC's Good Morning America.
I can't function. I can't think straight. It feels like I'm in a big nightmare.
Claudine Gates says she does not think her son would just go across the border like that. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 12:40 on Wall Street. We do check markets all day long here at Bloomberg. We're looking at a mixed market right now with the Dow just about flat on the day. We've got the S&P in the red. Little change there. NASDAQ higher by 26 points now, up by about 0.2%. Little change, though. The key takeaway here ahead of the jobs report tomorrow morning, which is expected to provide clues about the outlook for the Federal Reserve's next steps. And of course, as usual, complete coverage right here on Bloomberg Radio heading into the report and reaction to the number as it drops at 8:30 a.m. Wall Street time. We've got the 10-year now yielding 4.17% with a 2-year 4.88%. Spot gold little changed, up 90 cents the ounce to $19.35, up by about 0.1%. Bitcoin up now by 0.5%, still below 30,000 at 29,259. And West Texas Intermediate crude rallying 2.4% now, 81.38 a barrel. But before we get to the jobs report, we do have key earnings news coming up from Apple and Amazon after the close of trading. Amazon is a major focus for investors today. Bloomberg Intelligence retail analyst Poonam Goyal was a guest right here on Bloomberg Markets.
They have plenty of opportunity to expand into current businesses that they're in. They're also better penetrating themselves into the smart home market. They are pending an acquisition of the iRobot, so we'll see what happens there. But they definitely have used their Alexa devices to really ingrain themselves into shoppers' home and keep Amazon top of mind as shoppers think about what to shop next for.
And you can hear more of that conversation on the Bloomberg Tape podcast. You can download it wherever you get your podcasts. Amazon shares, they are up by 0.9%. Apple, of course, also after the close of trading, down now by 0.3%. Clorox shares are rallying after the consumer products company reported fourth quarter adjusted earnings per share that came in ahead of estimates. Clorox now up by 10%. Expedia Group reported second quarter revenue that missed analyst estimates. Expedia shares plunging now by 16.5%. Again, recapping, S&P just turning positive, barely up now by 0.5 point. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you, Charlie. We appreciate it. Jess Minton and Paul Sweeney here in the Bloomberg Interactive Brokers Studio. And up next, Paul and I are doing our C-suite conversations. And this time we're taking a look at credit scores. So Fair Isaac Corp. This stock is up 5% today, Paul. So ticker symbol is FICO, on pace for its best day since November of last year. So taking a look at this, the company did boost its revenue guidance for the full year. And you do have analysts seeing more signs of potential growth there if you're looking at Jefferies and Needham, both with buy ratings on the stock. So who better to talk with us about this latest earnings report than Will Lansing, CEO of FICO, who's here to discuss the earnings results as well as what's happening with the outlook with the industry. Will, thanks so much for joining Paul and myself. Walk us through with this latest earnings report.
Well, it's been a really good quarter. It's been a good year, and frankly, it's been a good decade for FICO. What's happened in the most recent quarter is that our software business has really taken off, and we can talk a little bit about how the software business has evolved from the scores business that you're probably familiar with. And then our scores business is as strong as it's ever been, and the combination of these two businesses, which is really what FICO's made of, scores and software, is driving the growth, big revenue growth. And we have new offering, the FICO decision platform, and that's growing over 50% a year. So it's just been just a great story.
So, Will, I'm a stock jockey myself, and FICO is a name we've used forever. It's been thrown around. Anytime we're going to get a loan, we think about where's our FICO score? What's our FICO score? And looking at your company, went public in 1987. So it's just amazing. Hit an all-time high today on your stock price, but went public in 1987. Lead manager Hambrecht and Quist, who I remember quite well. They were a leading investment bank on the West Coast, doing a lot of smart deals, including this one in hindsight. So Will, talk to us. I think we're all kind of familiar with the scores business. Talk to us about the software business. What is that business for you guys, and what are the key drivers?
Well, maybe just a little bit of history to be able to frame the software business, because it evolved from our scores business. So the company was founded in 1956 by a mathematician and an engineer. And their idea was a pretty simple one. It was, let's use data to make more informed, fact-based decisions. And if we can do that, we can lower the cost of making these decisions. We can make better, more precise decisions. And at the time, we were really an analytics consulting firm, and we would take any kind of work that came along, any kind of optimization work, anything that required data to drive a decision. We were interested. We rapidly evolved through the 50s and 60s to doing custom projects for banks, for financial institutions who actually had big dollar value decisions to make, and so it made sense for them to invest in trying to make a better decision. And so for the first 30, 40 years of FICO's existence, we were doing custom projects for different banks and also other industries, but a lot of banks. In 1987, we partnered with Equifax and launched the first kind of industry-wide score. And the idea was, we're doing these credit scores individually, bank by bank. Why don't we produce a score that the entire industry can use? And it'll lower the costs of evaluating credit. It'll make credit more accessible to more people. And that was what kind of drove us to this idea in '87 of launching an industry-wide score. We rapidly followed that score with scores with Experian and TransUnion. And so suddenly we had multiple scores available to evaluate credit with, and they were all built on the same kinds of data sets, that the data that comes from the credit bureaus. And most importantly, they were fungible. It was the same odds to score ratio for a score, whether it was produced by Equifax or Experian or TransUnion. And so you can imagine that was quite popular with the lenders. They love the idea of a low-cost way to evaluate credit and to leverage any of the three credit bureaus' credit files. So that was kind of the first half of FICO's life was building these kinds of custom projects and then eventually building an industry-wide score. Along the way, we came to a view that we should try to reduce this analytic IP that we have to software, because it's not just a credit file. You can look at a lot of different kinds of data to make a credit decision. And so we built software to do that. And the idea was we'd get returns to scale, software returns, as opposed to just being kind of an analytics body shop.
Right.
And that was successful also. And we wound up becoming the preeminent player in credit card fraud detection and a very strong player in originations and collections and recovery and customer communication. Virtually all the kind of key functions around underwriting and risk in a bank. So that was kind of been. I'm sorry. Go ahead, Jeff.
I was curious because obviously, since this is Bloomberg and we like to see what's ahead for the economy, I was curious as far as the analytics and what you're seeing when it comes to Americans and their credit scores, how that translates into either what you're viewing as far as the amount of people trying to take out loans and what that could mean for even approval, as far as how that ties into the economy and consumer credit at this point.
Well, people are as interested in credit as they've ever been. Obviously, interest rates are higher and mortgage volumes are down a bit because of that. But there are very few people who are not interested in what their credit score means, and because it drives the price of credit and it drives access to credit. And so we have a newfound, I'd say over the last 10 years, sensitivity and awareness of the impact of a credit score on kind of your life. What we're seeing is as much appetite for credit scores as we've ever had. We're selling more scores than we ever have, and the industry relies on them very heavily.
So, Will, 30 seconds left here. What's the key issue that you're getting across to your shareholders these days, the number one issue?
Well, our shareholders are well familiar with our scores business and how strong it is, what a powerful franchise it is. It's the industry standard and the cornerstone for U.S. credit economy. Our software business, which is built on this decisioning platform, is very powerful, and that's also driving our stock price. We've had this phenomenal run over the last decade, over 30% cumulative return, compound annual growth rate, and 24x over the last decade in our stock price appreciation. So that's driven by a recognition of the software, power of the software, as well as the scores.
Yep. All right. Hey, Will, thanks for coming on. Really appreciate getting a few minutes of your time. Will Lansing, the CEO of Fair Isaac Corporation, better known as FICO, and that is the New York Stock Exchange symbol, FICO. Stocks had
44% this year.
Yeah, stocks had a great move, a great run, and again, an all-time high today. We'll have more coming up. This is Bloomberg. Let's get some company news right now with Steve Rappaport.
Paul, big tech investors await earnings reports from Apple and Amazon. Those are coming after the bell. The iPhone maker is projected to report a third consecutive decline in revenue, while analysts will look at cloud computing growth for Amazon. Right now, Apple stock is currently down less than 0.25%. Shares of Amazon up more than 1%. The makers of two drugs that are part of a hot new trend for weight loss could pay a heavy price. More from Bloomberg's Jeff Bellinger.
Steve, a personal injury firm, is suing Eli Lilly and Novo Nordisk, alleging their diabetes drugs that aid weight loss can cause a paralysis of the stomach known as gastroparesis. Attorneys for Morgan & Morgan argue a Louisiana woman became so sick after taking Ozempic and Mounjaro that she made multiple visits to an emergency room and vomited violently to the point of losing teeth. The firm says it's investigating hundreds of claims linking the drugs to gastroparesis, which slows or stops the movement of food from a person's stomach to the small intestine. Steve?
Jeff, Novo Nordisk, in a statement to the Financial Times, says these kinds of drugs have been around for years, and delayed gastric emptying, nausea, and vomiting are listed as possible side effects. The union representing Hollywood writers is expected to meet with major studios tomorrow to discuss resuming negotiations. It will be the first sit-down for both sides since writers dropped their pens in protest nearly 3 months ago. Pay rates, smaller writing staff for shorter shows, and control over artificial intelligence in the screenwriting process are among the sticking points. Those are the company stories we're following this hour. I'm Steve Rappaport, and this is Bloomberg.
You're listening to Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, Jess Menton and Paul Sweeney here in the Bloomberg Interactive Broker Studio in New York City. Stocks have turned slightly positive, a little bit of green on the screen, so a little bit of a reversal. The S&P up about 1/10%, the NASDAQ up about 0.4%. We're keeping an eye on the yield space as well. We got some steepening of that yield curve. The 2-year Treasury is pretty steady at 4.88%, but the 10-year yield is up 9 basis points, 4.17%, so we keep an eye on that. Right now, let's head down to Washington, D.C. We'll get world and national news with Nancy Lyons.
Thanks, Paul. We're waiting for Donald Trump to appear this afternoon in a federal courtroom in Washington, D.C., as he faces new charges that he conspired to obstruct the 2020 presidential election. Bloomberg's Amy Morris with more.
This is the third criminal case against Donald Trump as he seeks a new term in the White House. He's expected to be arraigned in person, which means he'll enter an initial plea to the charges. Before the hearing, Trump will be processed. Fingerprints, personal information, but not mug shots, and he won't be placed under arrest. Trump is calling for the case to be moved from D.C. into West Virginia, a state that he won in 2016 and 2020. Today's hearing is set for 4 p.m. Eastern Time. In Washington, I'm Amy Morris, Bloomberg Radio.
Secretary of State Antony Blinken is warning of global food insecurity caused by Russia's war in Ukraine. In remarks before the UN, Blinken called out Moscow for pulling out of an agreement to allow Ukrainian exports of grain to continue.
Every member of this council, every member of the United Nations should tell Moscow enough. Enough using the Black Sea as blackmail. Enough treating the world's most vulnerable people as leverage. Enough of this unjustified, unconscionable war.
Blinken says grain prices have jumped by more than 8% since Russia pulled out of the deal. China is taking steps to limit how much time children can spend on their smartphones. The country's Cyberspace Administration says minors will not be allowed to use the internet on mobile devices from 10 p.m. to 6 a.m., and those between the ages of 16 and 18 will be limited to using the internet for 2 hours a day. For those between the age of 8 and 15, they would only be allowed 40 minutes. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. Now back to you, Paul and Jess.
Thank you, Nancy. We appreciate it, Jess Menton. And Paul Sweeney here in the Interactive Brokers studio in New York, and taking a look at this next story here that's on the terminal, Paul. Intern Hunger Games in full swing with VC Shop's public rankings. So New York-based company Insight Partners. So this is known for taking early stakes in ventures like DocuSign, Shopify, publicly ranks its investing interns using metrics like their phone calls, emails, and meetings. And this is a story, obviously, that is sourced by Bloomberg News. And the rankings are displayed on a so-called leaderboard for the firm. The sources did tell our reporters here, so who asked not to be identified because they are not authorized to speak about it. But some full-time employees are also ranked here.
Yeah, I mean, it's a competitive business, obviously.
It is.
You know, in the financial services business, venture capital, private equity, super intense, super competitive, always has been, and it continues to be today. And so you get some of these interns positions are highly, highly sought after. I mean, some of the numbers of resumes that are, sent in for some of these places is just staggering, and it continues to be. So if you're going to Insight, your metrics, how many phone calls you make, how many emails you send, that type of thing, those metrics are displayed publicly for all to see. Now, that is not, in my experience...
I was going to say, what was it like when you were doing
That's not, I mean, a lot of companies do that, particularly in the sales function, where it really is competitive, and they kind of put a leaderboard. You can see where you rank relative to your peers, both in terms of, maybe phone calls and emails, but where your actual sales commissions and your rank run. You can see that on live time and real time on these dashboards.
Maybe like Hunger Games Go.
That's right.
We don't have one, but
exactly.
maybe we can create
we've
a
got
function
them.
for that.
We've got them here. You just don't know them. So, and again, if you can't measure it, you can't management. Someone once told me that, and that kind of makes a lot of sense. All right. We're going to go to Joe Matthew. You know why? Because he got sound on. That's coming. Washington, D.C., the place you need to be, especially this afternoon. Sound on with Joe Matthew now.
about 1/10 of 1% here, was negative on the day, now green. We are also taking a look at crude oil, also on the rise after Saudi Arabia extended a production cut by another month, keeping output to the lowest level we've seen in several years. The kingdom hinted at even more cuts in the future. The Treasury sell-off is the big story of the day. It's hitting the longer end of the curve pretty drastically here. With the muted move in the 2-year, we are seeing much more stark moves in the 10-year and the 30-year yields at the highest levels since November, fluctuating throughout the day. You are looking at an 8 basis point move in the 10-year yield to about 4.16 and the 30-year at about 4.28. We have a ton of issuance as well. Earlier today, we have asked George Goncalves about this move in Treasuries, and this is what he had to say.
The belly of the curve starts to swing, and it could be swinging from Japan all the way to the U.S. That 5 to 10-year part of the curve is the most sensitive part for all parts of the yield curve, as well as for risk assets. And so, we're experiencing a wrecking ball from supply concerns, from concerns around foreign buying that's going to slow down, and I think all that's kind of culminating after an environment where rates have been staying under Fed funds for a long time, and that's been the saving grace for all markets.
A wrecking ball in Treasury markets. We have Liz McCormick now, who is Bloomberg's chief macro correspondent globally. Liz, when you look at the deluge of issuance paired with the downgrade that the United States is seeing, what is the ripple effect here that the markets are going to be feeling?
Yeah, I think what George was saying is right, that it's like, I was going to say, a trifecta of things. It's like you said, the deluge of issuance, Treasury kind of announcing even more than dealers had thought, and they were expecting a lot. So you have this wave of supply, which is weighing on the market. You have the BOJ, who is, kind of allowing some more room for long-term rates there to pick up, which may bring some money back home and out of Treasuries. And then I think, Shanali, the Fitch downgrade, though it's important in many ways, it didn't, a lot of the stuff we knew, like a lot of people knew, deficits are rising, the debt is too much, but what it did is really light a fire under people who weren't aware, and it's shown a light on it. So I think it's front and center in people's mind that we have debt coming because we have a deficit that, for as long as the eye can see is, in the, over $1 trillion to going towards up to $2 trillion level. So I think Fitch really just sparked everyone who wasn't aware of this to realize, and again, like you said, all the supply. So it was just too much, and the long end just took off.
Let's talk about the supply just a little bit more here, because so far you've seen the market been able to digest this idea of more supply coming to the market. You have the Treasury really boosting the amount that it is looking to borrow to fill the hole that it had. You and I love to cover TBAC, the Treasury Borrowing Advisory Committee. They have told Treasury Secretary Yellen here that they're comfortable with a larger share of T-bill supply as part of the outstanding debt. But at what point does the market start to break against this idea?
Yeah, that's a great point, Shanali, because that's what I like when I saw the documents come out for the Treasury. I was like, wow, look at what TBAC said, because that 20% was always the upper limit, and them saying, hey, we know it can go higher, and that's okay for a while. You have these forecasts coming now from Wall Street. We've already had about $800 billion since the debt limit deal of net new issuance of bills, and just today, Treasury announced bigger sizes of bills. People are saying you could have up to another $1 trillion more coming. So I think you're right. It's the point. There's been buyers. Everybody loves, the high yields and money market funds, and they're big bill buyers. But there is a point where, do dealers who are holding a lot of these bills kind of gum up the intermediation capacity of the market? So I think that's what's on people's radar so it's like from all across the curve, you're having lots more bills. You're having, they bumped up 2s, 3s, every tenor, the Treasury Department. So I think that's what's on our mind, and you and I have loved to talk about liquidity and, even just like the coupon bearing part of the curve. Let's see how the market holds up over, because dealers are saying not just the announcement we saw this week, but Treasury likely to announce more coupon increases next quarter and the following quarter. So it's a lot more supply on the horizon.
Some call it a wrecking ball. Some call it a slow-moving train wreck. That is Bloomberg's Liz McCormick. Thank you so much for your time. Meanwhile, we are waiting for the likes of earnings from Amazon and Apple after the U.S. closing bell. Dan Chung is Fred Alger, Management, CEO and CIO, and he's got a big play in tech. Talk to us about this wave of earnings that we're yet to see and what it could mean for the market, because, for example, Amazon, strong rally this year. It has not yet reclaimed its high, but we're sitting on some fragile footing here in the market.
So Amazon, we think, is actually one of the most interesting of the mega caps. Most potential for what we would call a re-rating upward, in particular because their retail business we think is going to become profitable and show expanding margins. And that is the debate around the company. The retail business there has basically been unprofitable, and in particular, very much subsidized by advertising, and then during COVID, very much burdened by the build-out in infrastructure. But we think they're about to turn the corner on that, and generally constructive on Amazon over the longer term. In terms of tonight's earnings report, a lot of their earnings reports recently have been fine, but met with sort of disappointed expectations, and that's the sentiment part of the stock market. We don't really try to predict that short term.
What about Apple? Because they have seen a broader rise here. Do you expect them to continue this rally given where we are in price to earnings multiples?
So Apple's a little different. I mean, it's actually pretty slow growth going at Apple, but it's also very steady growth. And we kind of think of Apple as sort of like a consumer staple almost. They do have opportunities, and Apple's opportunities are very large. Obviously, they dominate the tech industry with the iPhone and the iMac and the collection of technologies. Services is much faster growing than hardware. We think the weakness in hardware, iPhones in particular, has been well telegraphed. And so I think, again, actually, Amazon, in Apple's case, actually, there is a little bit of a margin story there. They had a lot of headwinds during COVID, extra costs for components, extra costs for shipping, logistics. We actually think they could surprise on the margins tonight, and revenue is probably just in line. Valuation, tough to say. We think it's sort of fairly valued.
Dan, talk to us about the meaning of big tech for this market. What else are the areas that you're excited about outside of those kind of big 4 or 5 names?
Well, I think, first of all, the market has been up 6 out of the last 7 months. So a pullback here is natural. We are growth stock investors, bottoms-up oriented, and we actually think it's increasingly clear that the economy is not going into any kind of severe recession. And in fact, it's a soft landing. And in particular, we think what will lead in maybe slower growth period that we're seeing, we are seeing some mixed reports around earnings, but slower growth will be secularly driven growth companies. And so technology, artificial intelligence is the big buzz, but it's real, and there's going to be a lot of investment around that. E-commerce continues and evolves. Digital advertising and social media continue to evolve. Healthcare, personalized medicine, and technologies around that. So we think there's a lot of growth trends, actually, that have continued through this period and will continue in the years to come, and that's where you want to put your money.
I know you're into NVIDIA, but what about the rest of AI? Do you think the market is following AI names a little bit too aggressively right now, still in bubble territory in some areas? Do you even go short in some of the AI?
We absolutely do go short some of the areas. I think AI, of course, has lifted a lot of stocks within technology and software and e-commerce. Who will actually be the real winners and when remains to be seen. When is an important note. I mean, there's going to be a lot of investment in building out the infrastructure to support AI activities and AI-driven products. Microsoft, NVIDIA will be winners in this. We think NVIDIA is going to be a near-term winner because their computing chips are the core foundation for AI. Other companies are probably going to benefit later. Other companies like, for example, Amazon and Apple, which haven't really laid out AI strategies, but have the technology, the customer base, the data about consumers, and a lot of things they could do both inside their business and outside it to improve using AI.
You also mentioned kind of this August pullback, weakness in the market, but there are some catalysts ahead. We had an investor yesterday mention, for example, the October budget discussions in Washington. That could be a potential real headwind to markets come October. Are you prepared for any further pullbacks in the market, and how would you play those?
Well, given the market run that it's had, we do think this pullback could be a little bit nasty. There are some indicators that suggest a 5 to 7% pullback would not be unusual. It could take 1 to 2 months. It could take a little longer. I happen to bet that it'll be shorter, mostly because I think the tailwinds to growth are still quite strong.
Where are you most bearish with that view?
Well, we're still bearish on things like real estate, in particular valuations around real estate that got driven up so much over the last 5 to 7 years with falling interest rates. We don't think they've adjusted and corrected for the new interest rate environment. Secondly, you have to look at the derivatives of real estate, so construction, suppliers to it, and actually the big suppliers to the real estate industry are the banks. We're pretty negative on banks that were, say, lending too much to commercial real estate as well as homes at inflated values, and think they're going to have a difficult time sort of readjusting their balance sheets to the new realities.
Dan, this has been a great conversation. Thank you for joining us today in studio. That is Fred Aldrin Management CEO Dan Chung. Up next, we're going to stick with the real estate conversation because we're going to talk to Brookfield Real Estate CEO Brian Kingston in an exclusive interview on the housing and office real estate outlook. This is Bloomberg.
Thing in life I've often said is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy in 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
Three prime ministers, 4 chancellors, an energy crisis, and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
This is Bloomberg Markets, and I'm Shonali Basak. Brookfield is one of the world's largest alternative investment management companies, and it's betting big on U.S. office real estate and other forms of the property market. But here's a breakdown of their flagship funds, with less than 10% actually invested in the U.S. office properties and 18% in non-U.S. office real estate. We're going to bring in Brookfield Real Estate CEO right now, Brian Kingston, for a exclusive interview on what Brookfield is doing. Brian, we broke earlier this year, according to our sources, that Brookfield is in the verge of raising $15 billion right now for a new flagship property fund. How are you going to be putting all that money to work?
Well, first of all, thanks for having me, Shonali. And, you know, look, we think we're coming into a very interesting period of time for real estate investment. You know, over the last number of years, there has been a pretty big buildup in inventories, et cetera, of real estate. And so we're seeing big, rapid price adjustments happening around the world. And our business really is globally diversified. As you showed on the chart there, we're in every major asset class around the world in 30 countries. And really, our business is investing in the backbone of the world's economy. And so we have a front row seat for all of these changes and you know, the things that are happening. And so we think we're coming into a great period of time where we're going to be able to put that capital to work at great returns.
I'm really curious about the office buildings here. I mean, it's a very controversial space right now. There are a lot of questions about how offices will make it through any hiccups in the market, especially given all of the changes around how and where people work. How are you viewing the office space in particular?
Well, when we talk about office, I think it's really important to distinguish between, high quality, modern, purpose-built office and older, commodity, more traditional office that's becoming quickly functionally obsolete. And so we often say that we're not overbuilt in office, we're under demolished. And what I mean by that is a lot of the issues or the vacancy that you're referring to is really concentrated in a pretty small component of the market. 90% of the vacancy in the US right now is in the bottom 30% of the market. And so for those higher quality buildings, like the ones that we own, Brookfield Place and Manhattan West, occupancy is actually very high. We're hitting record rental growth at Manhattan West. 2 Manhattan West is about to open up later on this year. Rents there are 35% higher than the tower that we completed right next door 5 years ago. So it's important when you talk about commercial office to really distinguish between that higher quality, modern, purpose-built.
You kind of hinted here on the big bet on New York City in particular, but how do you feel about the future of some of these cities? New York City, San Francisco, LA, clearly LA and San Francisco have been facing some really clear pressures.
Yeah, we've been doing this for a long time. I've been doing this for a long time. I think this is now the fourth cycle that I've been through that San Francisco was down and out. It always comes back, and I think longer term, there's a lot of reasons to be bullish about San Francisco. It is, really the center for a lot of intellectual property within the United States. It's a fantastic market to live and work in. It's going through some challenges right now, but we do think, any forecast looking 5, 10, 15 years down the road, technology is going to be a bigger part of our lives than it is today, and San Francisco is really the center of excellence for that.
What about Los Angeles? We've reported also that in downtown Los Angeles, you faced a building where there was a default on a loan. Do you stick with downtown LA?
Los Angeles is still the second most populous city in the country. There's a lot of investment opportunities to happen there. We have an enormous logistics business in Southern California. It's a major entry point, obviously, into the United States, and there's not enough being built there. So we think there's great investment opportunities in logistics in Los Angeles and in Southern California. Housing continues to be in very high demand there. We're still not building enough homes, and so multifamily and other sectors like that. But as I say, with office, there is a certain component of the market where it is more challenging because of the age of some of those assets, and I think that'll get worked through in time. Most of those buildings will get repurposed into other things or continue to exist.
Let's talk more about those defaults, because there are a lot of questions about how much more the market is bound to see in terms of default rates. Obviously, you're one of the biggest players in town. You and Blackstone have both faced defaults on certain properties. Bring us inside what that process looks like and the decision there.
Yeah, well, and I think it's important to distinguish between a default on a commercial loan and what most people think of with a residential mortgage default. And oftentimes, defaults get described as mailing the keys back to the lenders. That's not at all what's happening in these situations where you're reading about it. Oftentimes, these defaults are really just one step in the negotiation or in a restructuring of these loans. And so, as one of the largest users of the capital markets, we have a great relationship with all of our lenders. We're not mailing keys into people and walking away from assets. We're sitting down and working constructively with those lenders. And in many cases, for example, we had a default on a building in Denver recently that has now resulted in a 5-year extension on the loan, and it's back in good standing. And so I think this is all a natural part of working through the impact of some of the changes that we've seen with interest rates over the last 12 months.
We only have just about another minute here. Curious about the cost of debt. There's a lot of questions about higher interest rates, the lagged effects. How dramatically is the cost of debt rising, especially with such massive players like the regional banks stepping out of the market or being constrained?
Well, I think over the last 12 months, we've seen a really concentrated change in those interest rates, both because of the increases put through by the Fed, but also the widening of credit spreads that we're seeing in real estate. And a lot of that was driven by turmoil in the regional banks. We're starting to see all of that calm down now. The markets are settling back in. We expect rates are going to settle in at some point. The Fed obviously is closer than it was a year ago to stopping raising rates. And we think there's a lot of scope for spreads to come back down. So we actually see over the next 12 months those cost of interest rates actually moderating.
We'll have to have you back as you start to put that $15 billion to work. That is Brian Kingston. He is the Brookfield Real Estate CEO. just an update on today's big political story. Donald Trump is on his way from New Jersey to Washington, D.C. for his January 6th arraignment. We will have updates, and we'll be covering this story throughout the afternoon right here on Bloomberg. And still ahead, we will hear from Continental Resources Chairman Harold Hamm. Up next, this is Bloomberg.
There is no digital without chips, and I emphasize that because everybody speaks about the digitalization of the world. And I would even go a step further. There is no Green Deal without chips. So yes, it's a bit like the new oil for the world. And given some of these geopolitical tensions, especially between the US and China, it's become a necessity, I believe, to be more resilient against these geopolitical tensions. And while finding it out the hard way through the past 2 years during the pandemic, and what I mean with the hard way is that we've all seen how key industries in Europe and the US, especially in the industrial, medical, and automotive sectors, have suffered from a shortage of semiconductors.
This is Bloomberg Markets, and I'm Shonali Basak. We're going to turn now to our weekly Bloomberg Green segment, because earlier this summer, BlackRock's Larry Fink said he's retiring the term ESG, saying it's become weaponized and misused by both the left and the right sides of the political spectrum. And earlier today, Bloomberg's Alex Steele sat down with Continental Resources Chairman Harold Hamm in an exclusive interview, and as part of that conversation, they spoke about just this issue. We now bring in Alex Steele from Oklahoma City. She's live there. Thank you, Alex, for joining us. What did Harold Hamm say in response to BlackRock's moves?
Okay, so first of all, there's a couple things that Harold Hamm has to say about BlackRock. One is in his book, Game Changer, which is why I was here in his book launch. And in that, he basically says that Larry Fink has been very manipulative and cynically manipulated ESG for his own gain. I mean, really harsh words. Then when we spoke about that, I said, look, you were instrumental in trying to turn around the ESG mentality and really moving into the anti-woke world. And I said, do you think there's more legs to run? Do you think there's more juice in that?
Now, what does this mean for oil companies? Does it mean that they're all totally anti-green? I mean, he used some choice language with you here.
No, definitely not. And I think that if you ask any oil company today, they're going to talk to you about how much money they're going to be spending on things like carbon capture. Now, just because they're not necessarily going to be green or buying wind or solar doesn't necessarily mean that they're anti-green. And BNEF, for example, had a great piece out, and they talked about just how much money is going to have to be spent on the energy transition. And we're talking money from like $300 billion now to something like $14 trillion in about 10 years. I mean, these are rough timelines, but this is a lot of money. And that's where a lot of the oil companies, they like oil, they want to find oil, but they're doing other stuff, whether it's carbon capture, whether it's looking, say, for lithium, or using their technologies. We talked to Scott Sheffield, the pioneer, yesterday, and he was talking about finding lithium and minerals in water, so using other areas. Now, Harold Hamm said, no way is he doing lithium. He still likes finding oil, and he still thinks that there's some legs for that anti-ESG momentum. Here's part of that conversation that we had.
I think everybody got critical of what was going on with ESG. They suddenly realized how bad that was for business, how bad that was for the consumers themselves, and that shouldn't be happening. And there's been a tremendous amount of pushback right here in Oklahoma.
You can see, Shonali, as you mentioned, Wall Street kind of coming around to a new version of green or a new version of ESG. I don't know, you tell me.
Talk more about the oil market here, because you are seeing crude higher on the day. We have those hints from Saudi Arabia here about more output reductions moving forward above and beyond the month that they have already said. What does he say about the oil market more largely?
So this is interesting. He says he sees oil between 70 and 80. He doesn't see it going to 100. Now, we talked about this because in the book, he's very much into energy security and independence. And if the politics don't change soon against oil and natural gas and help promote those policies, we're going to be in deep trouble. And I said, but Harold, if that happens and you can pump more oil price is going to go down. Isn't that going to be hurtful to you? And he's like, short term, maybe. But longer term, he sees a real problem in the energy transition when it's binary, when it's only, say, wind and solar, or it's only oil and gas, and he thinks there has to be basically a transition, that you really do need fossil fuels to do that. And if you're against that or you have policies against that, it's really going to wind up harming energy security and energy independence. So we talked a lot about that. In terms of where the oil price is going, like I said, maybe around this level, maybe a little lower, not necessarily to 100, but he just wants the freedom, I think, to pump as much as he can.
Alex, thank you so much for your time and for that great interview. That is Bloomberg's Alex Steele. And we are going to take a quick check on the markets because we are near session highs. Actually, the S&P is in the green. The NASDAQ 100 is in the green. More markets up next on Bloomberg.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time? Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Limes.
The door was open for regulators to do more. And that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that. Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle. It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
This is Bloomberg.
I'm John Olupin. Welcome to Bloomberg Markets.
And I'm Sonali Basak. Matt Miller is off today. We're going to get a quick check on the markets because we are in the green, not by much, John, but by just a little bit. We have the S&P up less than 0.1%. We also have the NASDAQ 100 up more than 0.2%, right before some really big earnings coming out. I want to take a check at yields as well because the 2-year is not moving very much. It's only 1 basis point. We're looking at a 489 on the 2-year handle, but the more movement is on the 10-year and the 30-year. At the 10-year, you're looking at 419, 11 basis point move. Those are tighter financial conditions, and if you look further out on the curve, John, it's even worse. Take a look.
And certainly that yield story has played a role in influencing the stock market in this choppy session, Sonali. And then, of course, we've got all these earnings stories, which the market continues to digest. You've got Clorox shares sky high, up 9% today, some pricing power for that consumer products player. On the other hand, you've got Expedia down a whopping 15%. Now, some of what the company had to say echoes what we heard from some of the domestic carriers in the United States about the fact that there's been a lot of international travel, but less activity at home, whether that is a sign of an economic worry or just how people have been spending their travel dollars this summer, we shall see. And then you've got a lot of the tech stories we've been tracking. PayPal's profit problems front and center in this latest quarter. We're looking at that stock off right now about 10%. Etsy, its outlook worrying investors. It's down 11.5%. You mentioned more names to watch for, Sonali. Apple and Amazon set to report their results after the bell.
Absolutely. And earlier today, we talked to Bob Dahl, and he discussed his views on his earnings season outlook so far.
When you look at forward earnings expectations, full year 23, full year 24, not changing much as a result of the less bad than feared second quarter, same as the first quarter. So I think it's saying earnings are mixed.
Okay, let's bring in Linda Dissel from Federated Hermes, Senior Vice President and Senior Equity Strategist. That theme, Linda, of less bad, coupled with increasing calls that maybe a recession is not a scenario that will become a reality, have fed into this idea of possible momentum for stocks. And yet we've started the month of August with a little bit of uncertainty in the air. How are you characterizing the mood of the markets right now?
Well, I think that the market short-term was very much overbought, and so it was widely expected that August, which is notoriously a more difficult month, might see a pullback. And so far, that pullback is not very much. As you suggested, we're now positive on the day in the S&P, and then around 4,500 is a pretty good support level right there. It seems like it'll be a shallow pullback. As a result of the earnings season, as far as we at Federated Hermes could tell, we're actually pretty good across the board in many cases.
I guess one of the questions people wonder about is whether we see truly a pullback or whether we see a reassessment of where, in terms of the equity market, people want to be. For example, I know you've been watching the performance of, let's say, small cap stocks versus that outsized influence of those big technology companies in the S&P 500.
Right, and one of the most powerful reasons that many people got much more bullish here into the summer is that you actually saw a broadening of the market. So the Magnificent Seven, if you will, really haven't been hit that hard at all as the rest of the market has been broadening. And truly, everywhere, and you mentioned small caps, we were waiting to see if small caps would catch a bid, and they are. Cyclicals catching a bid, and they are. Really, and even the energy patch, which had a really tough first half of this year, catching a bid. The only place that really sees value right now is the high-quality dividend strategy, the defensive strategy, which actually did very well yesterday on the pullback.
Linda, when you take a look at those magnificent sevens, what would it take to crack the surface here and create more negative sentiment around these names, given where PE multiples are right now?
Well, the PE multiples are definitely high for these stocks and higher than they are for the rest of the universe. And that's it, but it's not outsized. If you would compare this time to back when the internet boom occurred back around 2000, you had eye-popping PE multiples. This is nowhere close to that. So these companies are getting the benefit, the nod for being extremely profitable, even as the outlook for the productivity enhancements coming with AI will really benefit them. So yes, they're expensive, and yes, the rest of the market is broadening and getting a bit more expensive too. But we could talk ourselves into holding on to these names for sure if we believe that the inflation problem is really settling down through the end of this year and into next.
But if inflation doesn't make rates go in a further upward trajectory, there are some other forces here, whether it's the Treasury issuance or the U.S. downgrade that could lead to tighter financial conditions, that could lead to higher rates. At what point does that start to filter into the market at a greater rate? And where has the market not been touched enough yet by the pains being felt in the rate markets today?
Well, if you look at the 10-year bond, and I believe that the entire yield curve is now over 4%, which is something that you couldn't have said for a long time. This is something that we're not used to, being insofar as we've been in a 0% Fed funds rate for 10 out of the last 13 years, but that in itself was unusual. A 4.25, I think, was maybe the high figure for the 10-year so far, and that isn't hurtful at all. In fact, a rising long-term yield is kind of a nod to the fact, a comment that the economy very well may avoid the economic recession that many had called for. So it's actually, I would argue, so far so good that way in terms of the yield curve. And we really, it's just hard to see inflation coming up so much to really rock this boat right now. That is not the problem. I think the problem will be if the jobs report is too strong, if the Fed gives us another rate hike and then says, well, and then maybe another, and then we keep raising our expectation for what the final Fed funds is. That's what could probably get us into trouble.
I'm glad you brought up all of those considerations, Linda, because, when you look at the historical interest rate hiking cycles and then look at what happens to the S&P 500 when we're near the end of one of those cycles, it does appear that performance for the broader equity market often depends on whether or not you see a recessionary environment emerge from that. And I guess that's what investors are going to have to try to determine if after this momentum we've seen for the broader S&P this year were to continue, let's say, into next year.
Yes, definitely. We felt all along that this year would be still a very strong year. There's just so much money sloshing about the system, and inflation is coming down. The question was never whether it would come down, but to what level it will come. And we won't really probably know that until well next year. If the inflation rate comes down towards 3% and not 2%, and the Fed would perhaps claim victory there and stop raising rates, just stay higher for longer, that is actually, I think, a pretty good scenario for the market. When they start cutting historically, it's often a sign that they see trouble and there's a recession, and the market starts pricing that in again. But just don't see that anytime soon.
Linda,
it's just too strong, and the earnings season has been very strong, particularly on margins.
Speaking of the earnings season, a very intense 24 hours here because we do have big tech earnings around the corner. We have the jobs report around the corner. How are you setting up for some of these catalysts?
Well, we of course, in the middle of earnings season, just as you said, you can have mixed information. You see some of these big names that had a great run year to date, even getting hit hard today. That's just the nature of the game here and the expectations. We look for mainly a GARP type strategy. If you're buying growth at a reasonable price, then you may not be outsized on your price earnings multiples. These mega names that you talk about that are going to be telling us their earnings today, among the Magnificent Seven, probably would have a very hard time disappointing enough to see those stocks get rocked. But maybe, maybe take a breather in here. As you acknowledged, these PE multiples are on the high side.
Absolutely. That is Linda Dussel. She is Federated Remay's Senior Vice President and Senior Equity Strategist on a big day, again, of earnings. The other big news is outside of markets, and that is former President Donald Trump's arraignment in Washington, D.C. occurring later this afternoon. The former President Trump is currently on his way there, and Bloomberg's Kaylee Lines is outside at the courthouse with details. Kaylee.
Well, Sonali, as you said, this is the third time the former president will have been arraigned, and he is going to travel from New Jersey, from Newark Airport to Washington Reagan National Airport, and then travel here to the federal courthouse at 4 p.m. Eastern time is when we expect this arraignment to happen. He will be fingerprinted, and although the former president said on True Social earlier this afternoon that he will be arrested today, the U.S. Marshals say that is not the case. He will not be placed under arrest, as we have seen with some of his previous arraignments. Nonetheless, it is definitely a very significant day in history, as of course, as I mentioned, this is the third indictment and arraignment of the former president. These charges he is facing are quite serious, from conspiracy to defraud the U.S. to conspiracy to obstruct an official proceeding, and conspiracy against rights, being the right to vote and the right to have one's vote counted. And if convicted on these charges, they could carry a penalty of up to 20 years in prison. This, of course, is just an example of the legal woes stacking up for the former president, and it's just yet another step in that today as he gets ready to appear here in Washington, D.C.
Kaylee, in terms of the messaging from the former president in anticipation of this, what has been some of the communication from him, and how does that compare to some of those other recent events you've referenced?
Well, the messaging has stayed fairly consistent, both from the former president, his campaign, and his supporters, that this is an example of a corrupt Justice Department that is being weaponized against him as he is seeking the presidency once again in 2024. He, of course, is currently in the running to be the Republican nominee in the next presidential race, and they say this is part of a two-tier justice system that is being targeted toward him, less so toward, for example, members of the Biden family like Hunter Biden. That messaging has remained fairly consistent throughout, as we saw in the indictment in Miami, another federal case related to classified documents, and in the indictment in New York, where Alvin Bragg brought charges related to hush money payments paid to porn star Stormy Daniels. And what we have seen in this is this messaging does resonate with Trump's base of supporters. In both of his prior indictments, we had seen his poll numbers climb in the aftermath, and especially after he was indicted, that first indictment in New York, he raised millions of dollars off the back of that. It only seems to add to and galvanize his support when it comes to the primaries. The thought being, though, is that this would affect him more negatively in a general election. At this point, of course, he is the presumptive Republican nominee, as he is so far ahead in the polls. But with these legal challenges stacking up and trial dates that are going to interfere potentially with primary races, it's going to be definitely quite a challenge for the president to keep this up and, of course, to pay for it as well.
All right, Kelly, helpful context. Thanks so much. Bloomberg's Kelly Lyons will await that arraignment, expected at 4 Eastern time. Coming up, the state of the private equity industry. Apollo, its stock hits a record high. We'll walk through what's happening with the business next. This is Bloomberg.
Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It was unimaginable that we would see rates move this fast. That was not in the realm of thinking.
Just the timeline of what they knew and when they knew it. Why didn't they do anything about it?
When do we have to see the kill? It's always for the Fed to respond to it, and this is really the tension.
Be informed.
You cannot be overly data dependent. You've got to have a view of where you're going.
Be prepared.
I think the earnings season might actually be the positive surprise that people are not expecting.
Be ahead of the game.
Certainly the beginning of something we need to keep an eye on.
And that, I think, is really going to be an interesting takeaway from this moment.
You go all birds on us and you say, turn, turn, turn. Is that what we're doing right now?
Yeah, big question coming into this year for us was, when is that turn going to be?
What a fantastic conversation.
The news you need.
The president's calling on manufacturers to make more in America. It is working, and it's reflected in these jobs numbers.
The analysis you trust.
How do you take this anecdotal data and say, really, just focus on the now, because that is going to tell you where we're going?
What is the measurement of uncertainty that we have in studying the American economy?
Milton Friedman had said there are long and variable lags in the impact of monetary policy. But man, it's a long slog.
The best way to start your day.
People are tuning into this program on a daily basis.
Oh, come on, it makes for good TV.
Let's move on.
Bloomberg Surveillance, weekdays from 6 to 9 a.m. Eastern. The names that move markets are on Bloomberg.
China has seen slower growth than they expected. Many countries do depend on strong Chinese growth to promote growth in their own economies. For the United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think we're in a good path.
Nobody covers business like Bloomberg, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Markets. I'm John Ehrlichman with Sonali Basak. Time now for our stock of the hour. Private equity giant Apollo shares sitting right now at a record high. Assets under management have been on the rise, and Apollo recording a record profit as it continues to focus on areas, Sonali, such as credit and insurance, which have been paying off.
Absolutely, and joining us now to discuss just that are Bloomberg's Allison McNeely and Cameron Leach. Thank you both for joining us because, Allison, you have not only a record high here for the Apollo shares, you also have them minting more than $1 billion in profit. What does this mean for the path forward for Apollo? As we know, when you hit a record, then the pressure is up to hit another one, isn't it?
I mean, I think what this means for Apollo is the path forward for them is credit. Really, we've seen the credit assets under management part of the business grow tremendously. Private equity has been going through a bit of a tough time right now, but with higher interest rates, there's a ton of investor demand for private credit, which is something that Apollo really specializes in.
Now, it's interesting because a couple days ago, you had just written this profile of Mark Rowan, who had taken over at Apollo and really has been known to be changing Apollo's image from this feared asset manager to your friendly neighborhood asset manager. You know, how much is that working for them, and is it true?
I mean, based on the stock performance, I would say it's working pretty well for them. As you noted earlier, the stock is trading at a record high because the company or the firm under Mark Rowan has really tilted more toward its Athene insurance arm. And so essentially it sells annuities to mom and pop investors or mom and pop retirees, takes that cash and then invests it in private credit securities. And this is really Mark Rowan's baby. It's his genius. It's his, his core strategy that he's had the firm pursuing over a decade, but especially in the last 2 years since he's taken over, and the stock market seems to like it.
Cam, does some of what Allison's talking about align with what you've been hearing and the creativity, not just where the investment's taking place, but how money is being raised right now?
Yes, of course. Even to Allison's beautiful story, I think Apollo generally has this brand of being such a shrewd investor and getting a value investor as well too, and getting people in negotiations to get the lowest price. I think now, just because I think there's a real race against private equity firms to kind of get outside of just the private capital world and try to make themselves a better name in front of other consumers as well too. So you're seeing them trying to make that turn, that twist, to kind of twist their brand a little bit to become a little bit better for value investors, individual investors as well too. Especially as just the fundraising environment has been tough just across the board. I think now they have to go back out there and find new LPs and new investors. And now, so we're kind of in a race against private equity firms. You have KKR versus Apollo, Vista versus Thoma Bravo. So I think now you're seeing private equity firms across the board kind of go out there and kind of brand themselves. They're tweeting more. They're being more active when it comes to engaging with the press as well too. So I think across the board, you see a lot of people trying to rebrand the firm.
Speaking of turns, Cameron, let's talk about Josh Harris shifting into the arena of the NFL and your reporting on that.
Yeah, sure. I mean, he just recently purchased the Washington Commanders for about $6.7 billion, which is one of the most expensive sports teams that's out there. We just released a massive quasi-deep dive into how that deal came to be. This is probably one of the biggest investor groups that the NFL has ever allowed to own a team. And I think this is the second act for Josh Harris. I think often there was I guess a theme that he had got looked over for the top job at Apollo, but they're really feeling like that's not really the case for him, and he has his own brand, his own thing. He's ready to do more outside of Apollo.
It's interesting to see what private equity titans are doing next. Allison, an investor made an interesting point to me this morning on how the NFL is not like English football and doesn't necessarily allow private equity in, which makes Josh Harris able to do this as a family office billionaire rather than an Apollo titan, if you will. But if you look at the challenges private equity is facing, you've also been reporting very extensively on the new structures that they're trying to put forward that, frankly, investors are just not biting on. What are they trying to do?
So extending on the theme of what Cameron was addressing in sort of the challenging environment for private equity, what we're really seeing is private equity firms essentially kind of going into a bag of tricks, you might say, to try and extend the life of investments to give them more time to wait for a better M&A cycle. Or if they can't, try and do something else to come up with liquidity, to come up with cash to return to investors. And one of the most popular strategies we've seen is something called a continuation fund. It's very technical, but basically it means that a private equity fund essentially sells an asset to itself by moving it from one fund into another fund and bringing in new investors. But these deals can be very controversial because there's concerns of essentially, if you're the buyer and the seller on both sides of the transaction, are you really getting a fair price? Are you really getting the best deal you could for your LPs?
Cam, are you, when you're talking to the street right now about some of those kind of structures, does it get too confusing? Does that message resonate?
It's getting tough for them across the board. Allison says they're getting into their bag of tricks, and I would say that's exactly right. I was just in Berlin, maybe like about a month or so back for a super return, and just talking to some of the top brass across a lot of the private equity firms, it's getting tough out there. Certain older LPs are wanting to get out. They feel they've been over allocated to a degree, especially as interest rates have risen. And now some of the top brass have had to, go out and, do some real pitching. They have to leave the top of the office, the top floor of the office to go out, find new investors and find new LPs. And I think that's part of the rebrand that we speak of in Allison's story as well, too. They are trying to go over into that next phase outside of just the private capital world and, find new investors.
All right, Cameron, thanks so much. Cameron Leach and Allison McNeely, appreciate both of you joining us as we continue to watch the private equity sector. And just an update on former President Donald Trump and his arraignment. He has boarded his plane just moments ago. We will have updates and be covering the story throughout the afternoon. Meanwhile, coming up, Bank of America reversing its recession call thanks to what's been happening in the data, whether it's the job story or consumer spending. We're going to hear from B of A's Chair and CEO Brian Moynihan next. This is Bloomberg.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, is all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
This is Bloomberg Markets. I'm John Oakman with Sonali Basak. Time now for today's For What It's Worth. How about 2%? That is Bank of America's new GDP growth call for the U.S. this year. It's up from the previous prediction of 1.5%. And B of A making headlines this week for no longer anticipating a recession. B of A becomes the first big bank to make that call. Earlier, the bank's chairman and CEO, Brian Moynihan, spoke to David Weston at the Aspen Economic Strategy Group's annual meeting about the economy and the health of the consumer.
So if you think about a consumer, it's their wages and wage growth. It's the money they have in their accounts from the stimulus and other things that went into their accounts during the pandemic. It's their ability to borrow. And then it's the rate at which they have to pay to borrow. And so if you think about all that, what we see is consumer spending. If we were talking last year's time, it was 10% year over year. And that was inconsistent with a low inflation economy. That now is down to 5%. So you've seen it drop by half. And so year to date is 5%. Month of July is 4.5%. So you're seeing it slow down. And what it's spending at in the month of July is consistent with a lower inflation. It's very much like it was in 17, 18, and 19 as the Fed raised rates and the economy sort of settled in. And so I think there's always been this battle between the consumer and the Fed, and the consumer has won the battle back a bit, but they got to be careful of overwinning it now. And now the risk really goes to over-tightening and slowing down the consumer too much, and then we would have a recession.
All right, and Sonali, as we look at the markets on this Thursday, right now investors are certainly trying to figure out whether or not this economic story ultimately plays out with a recession being avoided. Certainly we're going to be watching what happens when we get those jobs reports. Tomorrow's S&P right now close to the flat line. For Sonali Basak, I'm John Oakman. This is Bloomberg.
IPCC did what was called the 1.5 report. What was the difference between what a 2-degree world looked like and what a 1.5-degree world? And the catastrophe to the planet between those two poles led everybody to conclude that actually the job is bigger. We have to go to net zero. And that's a transformation of the global economy on the size and scale that's never occurred in human history. So that's a kind of daunting task, but it's full, I think, also of challenge, opportunity, the chance for innovation, and the chance to have the private sector play a fundamental role in making that change happen.
Friday, Wall Street Week comes to you from Colorado. Join David Weston for the 2023 Aspen Economic Strategy Group meeting. Special guests Cecilia Rouse, Raphael Bostic, Brian Moynihan, David Cody, Austin Goolsby, and Larry Summers join David Weston for exclusive conversations on persistent inflation, rising debt, and demographic challenges in the U.S. and around the world. It's a Wall Street week you won't want to miss. This Friday at 6 p.m. Eastern, only on Bloomberg Television and Radio.
DOJ or other authorities
could face bigger challenges next.
Fed was going to keep rate while up. This is a 3.
As the economic picture does.
The OK is getting ready to make a decision.
U.S. bonds are in the red. Stocks are a little bit all over the place. Live from Studio 2 at Bloomberg headquarters in New York, I'm Scarlett Fu.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. You take a look at the equity market right now. We're still in the red, especially if you look at the S&P 500, currently off about 0.1%, but that's a lot less than we were off earlier in the session. We'll see if we can close green. You look at the NASDAQ 100, currently unchanged when it comes to some of the big tech names. Of course, was under pressure yesterday, was under pressure earlier today, but again, fighting back. We'll keep an eye on that. Let's talk about bonds, though. Currently, you're watching a sell-off underway in the bond market, particularly at the long end of the curve. 10-year Treasury yields currently higher by almost 11 basis points, well above 4% at this point. Of course, we're on track for what could be the worst week this year for the Treasury market, and we should talk about crude as well. Of course, the news this morning was that OPEC is going to extend those production cuts. That's giving a lift to crude oil, currently up about 2.5%.
All right, outside of the markets, we are on Trump watch. Former President Donald Trump is scheduled to appear before a federal court right at the close of U.S. trading, this time in Washington. He faces new charges that he conspired to obstruct the 2020 election. Trump expected to be arraigned in person and enter an initial plea to the charges. This court hearing marks the third criminal case against him as he seeks to return to the Oval Office in 2024. Now, right around that same time, of course, we'll be on earnings watch. Amazon and Apple, two companies whose shares have been critical to this year's stock market rally, will be reporting. They both have durable revenue streams and they dominate share of their respective markets, whether it's smartphones or cloud services, but they also face macro headwinds and have limited direct exposure to artificial intelligence. So, Katie, plenty of after the bell action, but most of the action really today is in the bond market.
It's all about the bond market. We've had a lot of heavyweights weighing in, from Warren Buffett to Bill Ackman. Let's talk about the state of play. If you look at the longest end of the Treasury curve, we're talking about 30-year Treasuries right now. Currently, that yield sits at about 4.3%. That's the high of 2023. It's the highest level since about October of 2022, and a lot of that just came in the past couple days. You can see over the past 5 days or so, that long end is up about 25 basis points. So a really dramatic sell-off in the bond market, and it's not acting as much of a hedge either. If you take a look at the correlation between the equity market and the bond market, it's the most correlated on a 1-month correlation basis going back to 1996. So if you were looking for a shelter from some of the pain that we've seen in the equity market this week, Scarlett, it doesn't look like bonds have been your hedge.
No, definitely not. All right, let's kick things off now and get some perspective on this sell-off in Treasuries with Ethan David. She is Chief Investment Officer over at Moneda. Ethan, thank you so much for joining us. You heard the setup that Katie gave us with regards to bonds being where the action is. What do you attribute this week's decline to? What's driving this?
I think it comes from the change in the recession indicators and expectations that were discussed just earlier from representatives from Bank of America. We've seen this inverted yield curve for some time, which is, of course, the traditional signal of a recession. All of these strategists have been pushing out their recession estimates now. It's probably not going to occur this year, maybe not into next year. That, of course, changes the game in terms of the timing and even whether it will occur or not of a Fed pivot. So if we're not looking at Fed pivoting and reducing rates anytime soon, that would be the basis for selling off Treasuries.
And how much further do you think it has to go, given that we are adjusting to a new economic scenario?
I think it could remain weak, the demand for treasuries, for some time here. There's a whole recalibration that needs to go on now. We've seen a complete counter-narrative emerge around inflation, around recession. There is extraordinary resilience of the economy as well as of employment. So all of this is now feeding into a different narrative around what the Fed will have to do. And this is likely to perhaps bear on the traditional, as you said, that risk-off trade. And perhaps it's not in the long end any longer.
So where is the risk-off trade? Where is your safety asset right now? Do you find that in the shorter end of the Treasury curve or maybe some other haven assets?
It's quite ironic that the best risk-off trade recently has been large-cap tech stocks, which would never traditionally be associated with risk-off or defensiveness. But because of this muscle memory that markets essentially are using when they want to buy back into equities, which they've been doing for the most part of 23, they're relying on that muscle memory, which is that large-cap techs, it's unwise to bet against them. So they've been buying up these large stocks. We've talked a lot about how the equity market rally has been dominated by large-cap tech stocks. So that actually, ironically, is a relatively low-risk trade right now. Now, there will, of course, be volatility in that, but that's where we've seen that many investors have wanted to essentially have their first toe back into the water in terms of equities. Of course, traditional defensive stocks and the value sectors will perhaps be also better today because they have to then level up with the rest of the equity markets. So I'd see that has been somewhat a safer trade now going into some of those sectors. We've been in our portfolios advocating diversifying into real assets, real estate, infrastructure, all of these traditional inflation hedges, but with the tailwinds of the Inflation Reduction Act and beyond, should also look very strong.
It's a really interesting point that you make on large cap tech because that seems to be the safety place in the market, as you point out, especially if you look at the volatility of these different asset classes. If you really dial in on just big tech, it feels like there hasn't been much in the way of volatility. They seem to just go up and to the right. And then you look at the bond market, and most volatility measures there are still relatively elevated relative to history.
Absolutely. That has been an extraordinary thing for investors to contend with, is how to really play this volatility in fixed income. Ever since we saw this very steep cycle of rate rises, we're seeing that investors really don't know how to think about their bonds. You mentioned that positive correlation that we're seeing between stocks and bonds just now. We obviously saw that in a dramatic way in 2022. So how do investors think about the bonds in their portfolio? Are they the ballast? Are they the hedge? And with this volatility, which is only stoked by claims of problems in the regional banking sector, in other areas of finance, and it is just this uncertainty as to what exactly is risk off any longer. Can we think about government bonds as being low risk? Certainly UK investors couldn't have done that. So therefore, there's a whole question mark around fixed income. And equally, there hasn't been that much volatility in equity markets at all, really, over recent years. It hasn't really correlated with the returns we could expect in equity markets.
When do you expect that to return to a more normal dynamic? And we don't have much time left with you, but when you think about the differing volatility pictures, does equity volatility have to move higher here, or would you expect bond volatility to come down?
Both, in fact. I would expect bond volatility to come down, but perhaps not until we see some more visibility about the direction of the Fed, and we see exactly where we're going to come down from this 22-year high in terms of bond levels, bond rates. So therefore, that's one area. And also equity markets, perhaps this low level of volatility should be higher. We saw that last year, and we can hope to return back there. But what we're seeing is just because of this capital on the sidelines, it's flooding in to buy up equity in a bottom fishing way whenever prices fall. So because of that, I think it is perhaps viable that we will not see volatility returning to those levels. So definitely fixed income volatility coming down, but not necessarily a spike in equity market volatility.
All right, Ethan, really appreciate your joining us, giving us your perspective on both equities and fixed income. Ethan David is Moneda Chief Investment Officer. Coming up on Bloomberg Markets The Close, how good of a hedge are hedge funds providing? Kate Holleran, co-head of Capital Solutions at Barclays, joins us with a breakdown.
Plus, oil prices rise ahead of Friday's OPEC Plus review. Saudi Arabia says it will extend production cuts for another month. We'll get insight from Rebecca Babin of CIBC Private Wealth.
And what do the latest results from Warner Brothers Discovery say about the impact of the Hollywood strikes on the industry? Michael Morris of Guggenheim Securities has a buy on WBD and will be joining us with his take. This is Bloomberg.
hardest thing in life, I've often said, is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy in 1 minute, and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
Politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Barclays is out with a new report breaking down the performance of the global hedge fund industry. And I'm pleased to welcome Kate Holleran. She is co-head of capital solutions over at Barclays, and Bloomberg hedge fund reporter Hema Parmer joining us both on set. Kate, great to have you with us. Needless to say, 2022 was a bit rough for the hedge fund industry. How is performance looking so far this year, and what strategies have impressed you so far?
Yeah, no, sure. And again, thank you both for having me here this afternoon. So we're more than halfway through this year, and pleased to say that across the board, the hedge fund performance has been strong. I'll say it's been somewhat muted. It certainly feels muted, relevant to where equity indices are, and of course we have this new risk-free rate that is material this year. So there is that sentiment that of some mutedness, and I'd also say there isn't a sense of these home runs that we've had the last couple of years. Macro from last year, multi-managers, quant performance were fairly dominant. There's more or less of those clear trends that we're seeing this year, but overall good. Yeah.
So with the mutedness and then some of the trouble we saw last year, I'm curious what you're seeing in terms of redemptions across the space or expected redemptions through the rest of this year.
Yeah, so what we've seen, or what the data would tell us this year, is that flows have actually been positive. I will say, coming into the year, we put out a broader-based report every January, and that kind of guided us towards expecting marginal outflows. So, I will say that what we've seen from an inflow perspective is very muted, and then anecdotally, from conversations we as a team have day in, day out with both the LP and the GP side, asset raising is incredibly difficult, across the board. So, that really, I think, speaks to not a reflection of sentiment towards hedge funds per se, but the challenges of broader portfolio asset allocation that as an impact of 22 overall performance. And we came in expecting some redemptions based upon liquidity concerns that were front of mind for a lot of institutional investors, and anticipated that hedge funds, given the liquidity structure, might be impinged by that.
And given this tricky asset raising environment, we're seeing, it's really interesting, we're seeing some big hedge fund launches expected this year, but also it looks like the number of launches doesn't seem to be quite as competitive as previous years. So I'm curious how you reconcile this environment when it comes to the new launches. Yeah.
Sure, yeah. Look, the industry continues to consolidate, and it is ever more challenging for new launches to get off the ground. What we have seen is somewhat of an evolution in terms of who the sponsors are, right? There is very limited classic seed capital available. Some of the multi-managers have actually taken the place of that, which is very interesting, in their efforts to capture the best talent. And then the other trend that we see, and which persists, is the use of managed accounts, right? And the kind of unique structure of those gives institutional investors some comfort in terms of asset ownership. So both of those are key trends in the early stage space. But without a doubt, the bar has been raised, the threshold has been raised, and only the very top pedigree groups will be successful and get off the ground.
And like you said, it's been a difficult year to raise money outside of maybe those billion-dollar launches. And like you said, there's really no clear trend when it comes to performance. Is there a clear trend in where investors are actually putting money when it comes to strategies?
So we see a couple of things, and I'd say not a lot new, right? Certainly relevant to relative to our previous report. Investors are still looking for diversifiers, and that includes equity market neutral, it includes global macro, and also the multi-manager segment. And beyond that, credit remains top of mind. We're on the cusp of a particular point in time on the credit cycle, and there's a lot of interest in really seeing, what are those opportunities and how can I make space for them in my portfolio?
Yeah, it's definitely an interesting moment for the corporate credit market right now. And when you're speaking to allocators, what sense do you have of what they're viewing as the biggest risk?
In terms of credit or across the
board?
Across the board. Well, I'll zoom in on the multi-managers, right? And here the binding constraint has been talent acquisition, right? How can we capture more rather than actually asset growth, right? Which is typically the biggest risk of not being able to execute on your strategy. And that's a dominant theme that people are really looking or investors are really looking to understand. How can you not only recruit but retain the best?
And multi-strategy performance hasn't been too great this year. We were talking earlier about this idea of peak platform. Can you explain what that is, and are we there yet?
So, yeah, that is a recurring question, right? Will this growth persist? Because this has been the area of exponential growth for, the last 5 years, driven by the very high-quality return stream, diversification, downside protection that in volatile periods these types of funds have provided. Can they persist at this level? And as I mentioned, the binding constraint really is that talent acquisition rather than capital growth. On the investor side, they can't really get access to the groups they would want to, right? A lot of them have long wait lists. So should they be able to? I don't think that would be the concern. It's more, can the industry digest what they've absorbed, and what will be the next theme that comes for them? But I don't know that we've hit it just yet.
Well, we'll have to have you back soon when we do reach that peak. But gotta leave it there. Really appreciate your time and your insight. Our thanks to Kate Holleran. She is co-head of Capital Solutions over at Barclays, and our own Hema Parmar, of course, Bloomberg hedge fund reporter. Now, coming up, former President Donald Trump returns to Washington, this time as a criminal defendant. We'll have the latest on his first court appearance on charges relating to efforts to overturn the 2020 election. That's next. This is Bloomberg.
There is no digital without chips, and I emphasize that because everybody speaks about the digitalization of the world. And I would even go a step further. There is no Green Deal without chips. So yes, it's a bit like the new oil for the world. And given some of these geopolitical tensions, especially between the US and China, it's become a necessity, I believe, to be more resilient against these geopolitical tensions. And while finding it out the hard way through the past 2 years during the pandemic, and what I mean with the hard way is that we've all seen how key industries in Europe and the US, especially in the industrial, medical, and automotive sectors, have suffered from a shortage of semiconductors.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology. And welcome to Balance of Power.
This is Bloomberg.
This is Bloomberg Markets at Close. Let's hand things over now to Bloomberg's Abigail Doolittle, who is standing by with a special guest. Abigail?
Thanks so much, Scarlett. And joining me now is Sean Hare, President and CEO of Trinity Investments, a private real estate investment firm that owns $5 billion in luxury hotels and resorts in the U.S. and Mexico. Great to have you here with us today, Sean. And we've been talking for many months, and it's interesting that over that time period, so many things have changed in your world. And congratulations on one of these points, because you have successfully refinanced the Westin Maui, and we're hearing so much about CMBS this year. Now, certainly office and hospitality, very different, but there were even 2 San Francisco hotels that defaulted just a couple of months ago. But you've been very successful with your partner, Oaktree. Talk to us about why you were successful, and how was the transaction different than, say, a few years ago?
Thank you, and firstly, thank you for having me on, Abigail. I'd say, Trinity's focus is really focusing on brand-managed hotels, 300 rooms and larger, in destination-type markets. Hawaii is where we're headquartered. We know the asset very well. And we bought it with Oaktree and transformed the resort. So when we go into these assets, we renovate the rooms, we renovate all the food and beverage outlets, we've renovated the pools, we completely transformed it. And the result is the improvement in cash flow. So, of course, we've all been following the debt markets. They've been choppy of late. But for the right assets and the right markets with the right sponsorship, we're seeing the CMBS market being very robust. And we refinanced it, as you mentioned, recently with both Morgan Stanley and Deutsche Bank. It was a flawless execution on their behalf. They were phenomenal to work with. And Oaktree, as you mentioned, is one of our great partners.
And what were the conversations like with Morgan Stanley and Deutsche Bank? Were they different than they might have been a few years ago? Were the terms different? Were they asking for more or less? Were they willing to do extensions of any sort?
So the conversations, we normally borrow on a floating rate basis. So here we borrowed on a fixed rate basis because we're not sure what's happening with interest rates, etc. But we have the cash flows of the resort at, nearing a stabilization level, so we felt comfortable there. We felt comfortable taking out a 4-year loan with them. It's 3 years fixed and then prepayable after that. But it was a seamless conversation. We set out a timeline. I think it took about 45 days from start to finish, and it was very well received by the market. There were 2 big buyers of the bonds that bought most of the bonds. And I think it's just reflective of these irreplaceable assets in high barrier to entry markets.
Well, speaking of irreplaceable assets in great markets, you, of course, bought the Diplomat Beach Resort in Hollywood, Florida, earlier this year from Brookfield for $835 million, partnered with Credit Suisse, the 3rd largest single hotel property purchase on record. So it sounds like you really love that property, but you have an upcoming refinancing there. So do you expect to be as successful, and what did you learn from this process to play it forward?
Well, what I learned going through this whole COVID experience is that having the right assets in the right markets with the right partners helps you get through all of it. And again, we focus on these irreplaceable resorts. With the Diplomat, where in the country can you find 10 acres of land on the Atlantic Ocean, coupled with 10 acres across the A1A on the Intracoastal, a 1,000-room property with a 200,000-room convention center? We approached our friends and partners at Hilton and negotiated with them for it to become ultimately a Signia resort. And when we looked at all of that and what we were able to do from a renovation perspective, and with what's happening in South Florida, we've got this confluence happening where you've got strong leisure demand and group demand is coming back in a very strong way. So that's causing compression room rates are increasing, occupancies are robust, and it just fit perfectly what we do. 300 rooms and larger, destination hotels, brand managed, Hilton, Marriott, Hyatt. Those are the brands we typically work with, and they've been great partners through all of it.
So it sounds like you're not all that worried. In just about 20 seconds or so, Sean, what do you expect relative to the U.S.? I've heard so much in my research, Europe is hot, the U.S. is not, but are you seeing that at the Diplomat, or is it very strong?
The Diplomat is very strong at the moment. There has been some softness in some of the markets around the country. I think everybody's in Europe this summer, and that's mainly because Europe was closed last summer. But when we look at the outlook, we see a normalization of travel. These hotels, these resorts, these destinations are still very strong. Work from home is here to stay. We think that's causing companies to have more off-sites in destination hotels such as these. So there will be a normalization post-Europe. The dollar is a little bit weaker, so foreign travelers are coming back, etc.
Great perspective. Sean Hare, President and CEO of Trinity Investments, thank you so much for joining us for this interview today. And Scarlett, back to you.
Thank you so much, Abigail. Former President Trump due to appear at a Washington federal courthouse in about 90 minutes' time on charges he conspired to obstruct the 2020 election. Let's go now to Bloomberg's Kelly Lyons, who is standing outside the courthouse with more. Hey, Kelly.
Yeah, Scarlett, this will be the third time the former president has been arraigned. As you say, he faces 4 charges related to efforts to obstruct the transition of power after the 2020 election. He will be arraigned here at 4 p.m. Eastern time. We understand he will have his fingerprint taken. And despite the fact that the former president posted on Truth Social earlier this afternoon that he would be arrested, the U.S. Marshal Service says that is not the case. He will not be placed under formal arrest. As for where things go from here, he will be returning to New Jersey later on this afternoon, and it will become a matter of when this trial may be scheduled. The judge in this case, Tanya Chutkin, is an Obama appointee who has previously ruled against the former president, denying his request to deny Congress access to records related to January 6th. And she is also known for giving higher sentences than prosecutors asked for in January 6 cases. She will be the one that really kind of lays out the timeline from here. Jack Smith has requested a speedy trial. We'll see how speedy things actually are, guys.
Bloomberg's Kelly Lyons, thank you so much. We'll be checking in with you over the course of the next 2.5 hours. We turn back to markets right now. The NASDAQ 100 broke its way into the green. The big tech index currently up about 0.1%. The S&P 500 not exactly there yet, down by 0.1%. Those losses were as much as 0.6%. So we're getting there, Scarlett.
We're getting there, but it's a waiting game right now for the jobs report tomorrow, and of course, earnings this afternoon from Amazon and Apple.
Yeah, we got some big ones coming up after the bell, and of course that jobs report at 8:30 a.m. tomorrow. It'll be interesting to see how those boards change. But for right now, 10-year Treasury yields up 10 basis points, a sell-off in stocks, a sell-off in bonds. This is Bloomberg.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
This is Bloomberg Markets, the close. Let's get a cross-asset check as we head towards the close of commodities markets. Abigail Doolittle is looking at some big green arrows in oil.
Yeah, Scarlett, it's kind of interesting to see this contrast to stocks because the commodity complex is largely doing a little bit better here. Crude oil, you can see up 2.6%, natural gas too, up 3.3%, despite the fact that some of the heat has at least left this area. Copper, Dr. Copper, a big tell in the global economy, up 1.4%. And then wheat simply is unable to get a bid recently, really having to do with the idea that Ukraine may be figuring out a way to get some of its wheat out there so that supplies will be more abundant than traders had previously expected. So some green on this screen for commodities for sure, Scarlett.
All right. Thank you so much, Abigail. And as she mentioned, oil prices are rising after Saudi Arabia extended its oil production cuts by another month and hinted it's keeping its options open. So joining us now ahead of the OPEC Plus meeting tomorrow is Rebecca Babin. She's a senior energy trader at CIBC Private Wealth Group. Rebecca, always good to speak with you. Give us some context here on Saudi Arabia's move. It says it's prolonging its unilateral production cut by another month, and that deeper reductions, I should say, and more prolonged reductions could also be a possibility. What is it getting at?
Yeah, so I think, Scarlett, the thing with Saudi Arabia and OPEC Plus is they like to kind of surprise the market and put a jolt into what they see as a market that's been kind of overrun with speculative short sellers. You know, they've made the comment in the past that they want to see the short sellers ouch like hell. So I think some of those comments are rhetoric to keep the market on its toes. The fact that they extended the cuts was actually widely expected by most market participants through September. The question mark really is, do they continue to cut into October and into the end of the year? They are giving a leading indicator that they're strongly thinking about it, and those comments are what really has sparked the rally today. I think the second thing that sparked the rally today was that Russia also said that they were going to roll over a portion of their 500,000 barrel cuts. So they're only going to roll over 300,000 barrels, but most analysts had been penciling in that Russia would actually fully unwind those. So I think those two things are what's really driving the rally today. And I think it's in line with how Saudi Arabia really likes to kind of keep the market guessing, not certain what they're going to do next, and using really strong language to kind of manipulate as much price action as they can.
Rebecca, are we setting ourselves up here for a buy on rumors, sell on news when OPEC Plus does come out with its announcement of what happened at the meeting? We've already moved on this.
Yeah, I don't think when we get the joint ministerial meeting tomorrow that there'll be much of a reaction. I think it'll be a reiteration of what happened today. I think what we really should be looking for over the next week is what Saudi Arabia does with their official selling prices. If they choose to raise them, which they have for the past several months, it's a really nice indication that they want to continue to keep their barrels kind of out of the Asian markets and let let more of U.S. barrels travel over to Asia and clear some of the inventories out of the U.S. and allow the market to continue to rally. This has been the second piece of their puzzle. It hasn't just been that they've been cutting production, it's that they've been raising their prices and allowing the regional markets away from them to clear. So I think that's the catalyst that will continue the rally going, and most analysts think they will raise prices. It's also seen widely as a barometer of Asian demand. So that's going to come out tomorrow, most likely. I think that's what you really look for as opposed to the commentary from the meeting.
Well, Rebecca, if that rally continues, how high could it go? I mean, if we look at the price of crude right now, trading between $81, $82 a barrel, how much momentum do you think is left there?
I think that's the key question, Katie, is how much momentum is left there. And I would say I think that there is some momentum left to the upside, but it hinges really, really critically on what happens with China over the next several months. If we do not see China continue to grow and we see a real retrenchment, especially on the services side, I think we fizzle and we fade. That's going to be the key driver. If we do get stimulus and services continue to perform, momentum for Brent to get to 90, 95 is there, especially within this context that Saudi Arabia is going to be very fickle about bringing back supplies. The other key factor here is obviously the tailwind we've had in crude over the last month has been set by the macro environment improving, right? We've had a major reversal in the dollar and a stronger conviction of a soft landing in the U.S. A change there could really start to dampen the upside potential. But again, if it maintains and we don't get worse from here, there is significant chance we get to 90, 95 in Brent this year.
All right, Rebecca, gotta leave it there. Really appreciate your time as always. That is Rebecca Babin. She is Senior Energy Trader at CIBC Private Wealth Group. Now, still ahead, Warner Brothers Discoveries tempers its full-year profit guidance. More on the latest results with Michael Morris of Guggenheim Securities. That's next. This is Bloomberg.
Season is here.
Decent start to earnings season.
We are heading into the meat of earnings season.
Bloomberg breaks the numbers first.
We have Bank America, we have Charles Schwab.
Tesla, Netflix, you name it.
They're heading in the right direction.
A record quarter of revenue.
With exclusive expert analysis.
What do they have to deliver to justify the rally we have seen?
Earnings are still going to be under pressure.
Is there a divergence that's really important to draw here?
The massive divide between Diamond and Fraser.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
From New York City,
London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
In 2018, the IPCC did what was called the 1.5 report. What was the difference between what a 2-degree world looked like and what a 1.5-degree world? And the catastrophe to the planet between those two poles led everybody to conclude that actually the job is bigger. We have to go to net zero. And that's a transformation of the global economy on the size and scale that's never occurred in human history. So that's a kind of daunting task, but it's full, I think, also of challenge, opportunity, the chance for innovation, and the chance to have the private sector play a fundamental role in making that change happen.
prime ministers, 4 chancellors, an energy crisis, and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
Time now for top calls. Look at some of the big movers on the back of analyst recommendations, and we start with Wayfair. Gordon Haskett upgraded the home furnishing company to buy from hold and boosted its price target as well to $110, up from $65. The analyst expects that revenue trends in both e-commerce and home furnishings to bottom out, which will lead to further upside from Wayfair's improving outlook and profitability. Shares absolutely flying, currently up about 18%. Next up, we have Southwest Airlines hit with yet another downgrade within the last 2 weeks, this time from Jefferies, cutting the recommendation to underperform and slashing the price target to $25. Concerns include an unattractive cost outlook, limited margin visibility in 2024. You can see shares currently off by about 2.7%. Finally, we have streaming platform Roku. It was cut to neutral from buy over at Citi. The analyst sees limited upside given that revenue re-acceleration already priced in after the run-up that we've seen so far in the shares this year, currently off about 2%. And those are some of our top calls. Now, Warner Brothers Discovery shares higher after the company reported smaller than expected quarterly losses from streaming. Of course, the company is home to CNN and HBO. And joining us now, I'm pleased to say, is Michael Morris. He is Senior Managing Director over at Guggenheim Securities. He has a buy rating on the stock. And Michael, initially it was lower. It seems to have clawed its way into the green. What do you make of this morning's report?
Well, I think it was a good report on balance. I think that what you just referenced with respect to some of the reaction shows that there's a little something for everyone. But I would focus on a couple of the positive things that I think came away, the most important of which is the progress that the company is making in generating free cash flow. As most people who follow the industry recognize, the media industry, the television media industry in particular, is facing a number of challenges with respect to consumer behavior moving away from linear TV and into streaming, and how the media companies are tackling this is probably the single most important issue for the industry. Warner Brothers Discovery is a company that is generating positive free cash flow as it is navigating this challenge, which is a commitment that they made to the street when they completed their acquisition of the former Time Warner assets, and they're delivering against that commitment, both up to this point, on this quarter, and as they look forward. So there are a number of other things to discuss, but you ask about the one most important thing to take away, and I think that's what it is.
That seems to be a theme, too, if you look at some of the sell-side research that has come out in the wake of that report. The free cash flow, obviously a beat there. How does that stack up against some of Warner Brothers' peers in the industry right now?
A very fair question, and the peer group can be described a little broadly. Most people think about the traditional media industry or the television channels-based industry, companies like Disney, Paramount, and Fox, each which have different pros and cons. But in general, the launch of streaming services and the growth of streaming services by the companies I just referenced, if they have embarked on them, so Paramount and Disney in particular, has been accompanied by some pretty material losses.
Yep.
We would call those investments, of course, as the companies are looking to build a business with long-term growth potential. But by contrast, Warner Brothers Discovery has moved really close to profitability at their streaming business, and like we said, has maintained a very positive level of both profitability and free cash flow on a consolidated basis. The other thing I would mention is that I do think it is worth discussing Netflix in that conversation. Certainly, Netflix came from a place that didn't have the legacy baggage and focus solely on a streaming business, but I think that that type of business is what a company like Warner Brothers Discovery should be thinking of and targeting as they think about their objectives.
So when I look at Warner Brothers Discovery and what it said, they tempered their full year guidance, saying the performance will really depend on when the labor strikes get resolved and, of course, the state of the advertising market. You mentioned Netflix. Netflix is a clear beneficiary of the strikes because it doesn't have to spend as much money. Does Warner Brothers Discovery also benefit the longer the strike drags on?
Well, it's a complicated topic. I want to point out a couple things. I'm not 100% sure I agree that Netflix is a beneficiary of the strikes. There are puts and takes. Both Netflix and Warner Brothers Discovery have certain characteristics that position them better than the industry at large in the context of the strikes.
Okay.
Netflix has a very diverse pool geographically that they're able to draw from with respect to populating their service with new content. So to the extent that the strikes are a domestic phenomenon or event, this is a company that generates the greatest amount of its content on a percentage basis from markets outside the U.S. And so that is a net benefit for them, even though I think the strike could be a challenge for them. Similarly, with Warner Brothers Discovery, it's a business that generates a significant portion of its attention and revenue from content genres that are not strike impacted. So that's nonfiction content, it's sports content, it's news content. You know, we estimate on their linear businesses that over 90% of their ratings come from those areas rather than scripted. So relative to other businesses, they are somewhat better insulated. But overall, every one of these companies for the long term will be better off with a resolution on these talent strikes.
Well said, very nuanced, although you're right. In the meantime, Warner Brothers Discovery does certainly get some shelter, get some cushioning from its stable of reality programming. Michael, thank you so much for joining us. Michael Morris of Guggenheim Securities on WBD. Coming up, key players in economic policy and business gather in Colorado for the 2023 meeting of the Aspen Economic Strategy Group. Karen Dinan of Harvard and former U.S. Treasury Secretary Chief Economist will join us next on the outlook for federal debt. This is Bloomberg.
Thing in life I've often said is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy in 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like. But the more you could be you, the happier you will be.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
are looking at live pictures right now of President Trump's private jet coming in from Bedminster, New Jersey, due to arrive at Reagan National Airport in about 15 minutes' time. Of course, the former president has been summoned to appear before a federal court in Washington, facing 4 criminal counts on conspiring to obstruct the 2020 presidential election. We will bring you images of his arrival when we get them. In the meantime, it is time now for our Wall Street Week Daily segment. David Weston is on location in Aspen. Hi, David.
Hi, it is a long way actually from the Reagan National Airport in D.C., but we're in Aspen for the Aspen Economic Strategy Group meetings, and we're joined now by one of the people who's doing some of the work that they're talking about here. She is Professor Karen Dinan. She is from the Kennedy School at Harvard. So welcome, Professor. It's great to have you here. You've been doing important work on the question of the deficit and the debt. Very much in the news this week with that Fitch downgrade in the ratings, and people talk about whether it matters or not, but some of what they had to say is some of the things you've been studying.
Yeah, that's right. I mean, it's interesting you mentioned the Fitch downgrade. I think there's been a lot of debate over kind of the timing of the announcement and what it means about U.S. credit quality, but the thing that people agree on that comes through in the report is the fact that we are in an unsustainable situation in terms of U.S. government debt. And that's really the starting point for my work.
So quantify it a little bit, because I know you are working on this right now. You got a paper that's going to be coming out in the fall. Yeah. And it has some of the numbers, and they're not just your numbers, as I understand it. They're Congressional Budget Office numbers that project out that are fairly scary.
Yeah, they are scary numbers. I mean, so first of all, you have to understand where we are now. So debt is nearing 100% of GDP. That would put us, that alone puts us at one of the highest levels on record. But then if you look at CBO's projection going out the next 30 years, we're getting up there to 180% of GDP by the end of 2053. Which is a level that, again, there's widespread agreement. That's a level that is going to be putting the economy at serious risk.
We've been borrowing money for a while, but we did have a couple of big crises that came up. We had the great financial crisis. We had to borrow money for that. And then, of course, we had COVID. How much of the problem we're in right now are attributable to those two big problems?
Yeah, so those two events, I mean, they were big ones in terms of the path of debt that we're on right now. I mean, you can look and you can see that I think before the Great Recession, we were at debt was something like 40% of GDP, and the thought that we might go up as far as 100% of GDP would have been just unthinkable at that time. People would have said, oh, that would be a catastrophe for the economy. But both those events kind of led us to kind of ratchet up in terms of the level of debt.
So it's bad for those of us who don't understand the way you do, but it seems bad and it's getting worse. But how much debt is too much debt? How do we know we've gone too far?
Yeah. I mean, that is a really tough question. There is no agreement amongst experts about how much is going to be too much. And I would say I think that's part of the problem. Without some predefined level at which things become really bad, it really does not provide a lot of pressure to take action on this. So we don't know, but what I can say is that there is widespread agreement that by the time you get up to levels like 140, 150%, it's just going to be very, very costly. If we avoid a crisis, it would still be really costly for the economy.
We all want to avoid a crisis, but sadly, sometimes in Washington, it looks like you almost have to get close to a crisis before something gets done.
Yeah.
As we get in worse and worse shape, where will we feel it? Where will it show up first that we'll say, oh, now we're really in trouble?
Yeah, well, so it's all a question about getting people to buy our debt. And so what you get when you have a lot of debt out there and it's rising is you'll see rising interest rates. And so one place we're going to feel it is that those rising interest rates are going to make it harder for firms to do private investment, and that's going to be harmful for our growth.
We already have higher interest rates, in part because the Fed is society wants to get inflation under control. What does that mean in terms of our interest payments? Because what does that do in terms of the budget? How much of the money we have to spend every year is already spoken for because we owe it in interest?
Yeah, so I think that is a really important point. We understand some of the things that are contributing to high debt. There's a strong demographic story that has to do with the aging population and the cost of providing income and health care to that population. But the other thing going on in the background is the interest payment. payments. So we're starting now at this high level of debt. And then with debt getting higher and higher, you get interest rates kind of ever rising, contributing more and more to rising debt. And so they come to kind of dominate the trajectory of debt by the time you get out a couple of decades.
One of the things that I've heard from some people out here in Aspen at this conference has been, you know, we don't have to worry about this quite so much because we're better than everybody else is. We might not be good, but in fact, people still want to invest in the United States. Yeah. People still want to buy our debt. How much solace should we take from that?
I mean, it's something that has worked. That argument has worked for a while for us, but it's not something that's going to work forever. I mean, the higher debt gets, the more investors are going to worry about whether we can actually pay back that debt, and that's what's going to then potentially drive interest rates ever higher.
What is the political will to do something? That's one of the big questions here. The answers may be difficult, but we may have a sense, particularly the people out here, the economists such as yourself and others, have a pretty good sense of what we need to do. Yeah. But there's a big question about how you can get people to do it.
Yeah. So I think first of all, the point you made about economists have a good sense of what needs to be done, that itself is an interesting point. I think a lot of people think, oh, this is a technically hard issue, but what we've seen at this conference is a bunch of people saying, well, gee, if you do this and you do that and you do that, you can make real progress. So it really is a question of the political will. That's a tough thing. I think, you know, part of the problem is that the public does not feel alarmed about this, and the public is not kind of telling their leaders that something needs to be done about this, but it's a chicken and the egg problem, because kind of the public listens to its leaders when they're thinking about, well, what should be a priority for the country.
Yeah, and some of the crises we faced already, we won't want any more to happen, but you can't rule them out. And I'm not sure how much fiscal space we would have to deal with another problem like we had in 2008 or like we had with COVID.
Yeah, no, that's right. I mean, you asked me, you know, where do we feel the pinch, and part of it is kind of the ongoing issues with higher interest rates, but another big issue is just that we will not have this fiscal space to deal with another crisis. And if there's anything we've learned, you know, over the past dozen years, you know, things happen that we do not expect, and they can be very costly for the government.
So finally, what do you hope to take away from this conference? Because you've been working on this paper, you took a bunch of comments and things. What do you hope to come out of it?
I think getting the message out that we're in this unsustainable situation is an important thing. But I also think kind of the meeting of kind of experts together with people who have deep experience in policy could really maybe kind of you know, help us make progress towards figuring out what needs to be done in terms of the process to get something done on this front.
Professor, great to have you with us. Thank you so much for being with us here in Aspen. That is Professor Karen Dinan. She is from the Harvard Kennedy School. Scarlett, thanks so much. Back to you.
All right. Thank you so much, David. Great conversation. Of course, you can see more of David's interviews from the Aspen Economic Strategy Group tomorrow at 6 p.m. New York time on Wall Street Week. We want to take you back to Washington right now because former President Trump just arrived at Reagan National Airport. There's his private jet. He flew in from Bedminster, New Jersey. And of course, he is headed over to a federal court in Washington. He will be going to E. Barrett Prettyman Federal Courthouse, where, of course, he'll be arraigned in person. He faces new charges tied to his conspiring to obstruct the 2020 presidential election. We understand that the court hearing will begin at around 4 p.m., and we will take you there when we get to that point. And, of course, there is a courthouse. Right now, it looks kind of quiet, Katie, but we know that there is a lot of security around the building, given what has happened in the past every time there's a President Trump event.
Absolutely would expect heavy security presence, heavy media presence as well, of course, as we track this. And we know that inside the building, the U.S. Marshal Service spokesman confirmed that Trump will have his fingerprints taken digitally. He'll be required to provide his social security number, date of birth, address, other personal information. Won't have his photograph taken, though, as he's easily recognizable.
Everyone knows who he is.
Everyone knows who he is. So we'll keep an eye on that and bring you more news as it crosses. But let's take a look at the markets right now. Pretty tepid day in markets. The S&P 500 fighting to get into
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenivek on Bloomberg Radio.
Good afternoon, and live from the Bloomberg Interactive Brokers studios, streaming on YouTube and at Bloomberg Originals. It's Thursday, August 3rd, 2023. I'm Tim Stenivek, along with my co-host, Madison Mills. Carol Masser is off today. Stock market, not really doing much. In fact, the Dow is flat. The S&P 500 just down fractionally right now. The NASDAQ is in the green by about 0.2%. The bond market, though, that is the focus today. The slide in the world's biggest bond market deepening. Stock's a little changed, though, after coming back from a sell-off a little earlier in the session. Madison, we got a great show today.
We've got a great show, a lot of news, particularly coming out of D.C. At 4 p.m., President Trump scheduled to appear at the federal courthouse down there on charges that he conspired to obstruct that 2020 presidential election. So we'll be monitoring that, but that's not the only big news.
Yeah, it's a huge earnings day today. We're talking mega caps. We got results from Apple and Amazon after the bell today. And did you see the new cover of Bloomberg Business Week?
I did see it.
Wow.
It is scandalous.
It is scandalous. This story, murder, money, and the battle for a pharmaceutical empire. Yeah. I couldn't put it down. Almost 6 years after Barry and Honey Sherman became two of the wealthiest people ever to be murdered, police still haven't identified the killers, but they've turned up no shortage of potential suspects and a bare-knuckle family drama. We're going to dive into that a little later in the program with Joel Weber.
Yeah, and of course, one of my favorite topics, because it's going to be directly impacting my household budget of one over here, the return of student loan payments.
Hey, there are two in your household.
Me and my son, Billy,
yes,
who is a dog, so everyone is aware, who is negatively impacting Tim and I's output today. Apologies for that, Tim. But
that's okay. You know, when you got to take care of the dog, you got to take care of the dog.
But seriously, it's a huge story. It's impacting thousands of Americans and could potentially be another aid to Jay Powell's anti-inflation fight as we head into the fall.
It's a really remarkable story about people who are just saying, you know what? I'm done paying these things.
Yeah.
Not going to do it.
And I kind of see where they're coming from in the sense that they've gotten leeway on those payments previously. So if you could get away with not paying them off by waiting a little bit, I could see the argument for that. The problem, of course, is interest on those payments. So we're going to get to talk about that today.
And I like how you talk about the inflationary angle, because we're going to touch on that one as well. Don't go anywhere, though, because in just a few minutes, we're going to be joined by our TV team. We are going to talk to them all about what they're expecting at the close. That's coming up in just a few minutes. And then, of course, I can't tell you enough how excited I am for these mega cap earnings after 4 p.m. today. First off, though, let's bring in our TV colleagues as Bloomberg's Countdown to the Close starts right now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the Countdown to the Close. Scarlett Fu and Katie Greifeld here on the TV side. We're joined by our colleagues Tim Stenivek and Madison Mills in Bloomberg Radio. And of course, together, the four of us welcome all of our audiences across TV, radio, YouTube, Originals. Am I missing anything?
I don't think you're missing anything. You said YouTube, you said TV, you said radio.
There we go.
We're multi-platform.
We're cross-platform in every way. What are you guys keeping an eye on right now?
Yeah, I can't stop thinking about this Brian Moynihan, Bank of America chair and CEO. He sat down with David Weston in Aspen a little earlier in the day today. They covered a lot of ground. They talked, of course, about proposed new capital requirements for banks, Fitch's downgrade of the U.S. and more. But what I want to highlight is what he said about the U.S. economy. Check it out.
That's sort of an unemployment with slowdown, which is really what's going on, and we could talk more about it, but that's what's really going on is people are employed, they have money, they're spending money, and the Fed is trying to slow down the economy, and it looks like we're reaching a pretty good equilibrium.
Yeah, I like to highlight this because Bank of America has such a good read on what Americans are doing, Maddie. They have instant data on what we're doing with our debit cards, what we're doing with our credit cards, what we're doing with our homes. And listen to what he said. He said that, you know, people are employed, they have money, they're spending money. It looks like we're reaching a pretty good equilibrium between employment and the Fed. Not bad.
And as you pointed out to me previously, Tim, and I think it's so important to continue to think about, 2/3 of this economy is consumer spending. And as Moynihan is saying, people are spending. Having said that, though, I have to wonder whether continued credit tightening and people putting more on their credit cards is going to be a negative headwind as we head into 2024, if that's going to be the next shoe to drop, Scarlett.
Yeah, eventually, if we do get a more meaningful slowdown or recession, that will be something to watch out for. It's interesting to hear Brian Moynihan's take versus other chief executives, Katie, because this narrative change that we've gotten about this recession not actually happening, and maybe we can achieve a soft landing is definitely picking up steam.
Yeah, it bleeds really nicely into the story that we're keeping an eye on here over on the TV side. It's almost like we planned this. If you take a look at the Conference Board measure of CEO confidence, that's in collaboration with the Business Council, it climbed 6 points in the third quarter to 48. It's below 50, which is bad, but that 6-point climb is pretty amazing. Actually, nearly 1 in 5 chief executive officers say that they expect the U.S. economy to avoid slipping into a recession. So that means the majority still expect them to, but a little bit of an improvement on the CEO front.
Yeah, absolutely. In fact, 84% of CEOs still say they're preparing for recession. That's very different for whether they actually believe one will happen. You could argue that they've been preparing for recession, Tim, for the last year or so.
Yeah, you read my mind, Scarlett. I mean, that's been the broken record for the last 18 months, right? Is when is there going to be a recession? I think that the unexplained thing that we're seeing is certainly the bond market and the inversion that we're seeing, and whether or not that's actually going to lead to a recession. We know there is going to be a recession at some point. That's a normal part of an economic cycle. It's just, does it happen at 2024? Does it happen 2025? Does the Fed pull off a soft landing? I think that's the question.
Well, and there was that B of A note yesterday that we've been talking about, ending their recession calls. But later on in that note, what I thought was so interesting is that they talked about the Fed's bottom of that terminal rate there, staying higher for longer. And I wonder if there's going to be a negative impact on the American consumer that we're not pricing in here if the Fed does not cut rates as much as we are thinking that they might.
Well, specific to that Bank of America call, we'll be speaking with Michael Gapin at about 3:30 on the TV side. So really looking forward to that conversation.
Katie, what are you more excited about, Amazon after the bell or Apple after the bell?
I'm most excited for the jobs report at 8:30 a.m.
That's tomorrow.
Ooh,
you can't be thinking about tomorrow yet.
Yeah.
All right.
Just like the markets, relentlessly looking forward.
She's priced in Apple and Amazon already.
Or discounting mechanism.
Exactly.
All right. Well, we are expecting Amazon just after the bell, and then Apple, of course, coming at 4:30. Wall Street time, as it usually does. We are going to be back together live on TV, radio, YouTube, and on Bloomberg Originals at 4 p.m. for our Beyond the Bell coverage when we take you through today's market close. We'll see you all then.
This is Bloomberg Business Week with Carol Messer and Tim Stenivek on Bloomberg Radio.
Madison Mills and Tim Stenivek in our Bloomberg Interactive studio. Tim, so fun doing this with you as always, especially... You're welcome. Thank you. Oh, my goodness.
Oh, and my mic wasn't on.
Your mic
I said,
wasn't
thank you,
on.
Maddie.
Thank you, Tim. It's a big day, and I'm excited to get to dive into all of the news flying around out there, because analysts have been wondering for weeks when traders would stop kind of ignoring these higher bond yields. And now they don't have a choice, because yields on 10-year treasuries have surged 40 basis points in the past 15 days to the highest levels of the year. So we're going to discuss kind of what's driving these moves in the bond market and what we need to know moving forward. And to have this discussion, we've got Bloomberg Intelligence Chief U.S. Interest Rate Strategist Ira Jersey on the line, and Bloomberg Chief Correspondent for Global Macro Markets Liz McCormick. Liz and Ira, thank you both so much for joining us. Liz, I want to start with you because there's a confluence of factors happening at the same moment. I'm curious, from your perspective, what is the single biggest thing driving the bond market right now?
That's not a fair question, because I really do think it's an amalgam of all these things. You've got the BOJ, who, we know recently kind of tweaked gave some more room for long end yields to rise. We have a barrage of supply that the Treasury Department announced, which people thought was coming, but it was a little bigger than expected. So we have that. We had good data this week, ADP, even today's data. We had a lot of things that were building. And of course, like Katie, I know it has him on TV, Mike Gapin's, taking away the recession call from Bank of America. So I think it just all kind of like exploded. And I do think there's also, remember that curve flattening inversion trade was a big winner for people. And I think people were trying to bet on the steepening, and it's gathered momentum. So I think you have people just plowing out of the flattener. So I don't mean to avoid your question, but I think it's all of it together.
Yeah.
Well, Ira's had a little bit of a time to listen to Liz and to think about his answer to that question. So I'm going to ask you Maddie's question, Ira. What is the single biggest thing driving the bond market right now?
Well, I agree. There's no single biggest thing. We always want to try to get the simple solution, but there is no one thing that's causing this move. I agree with Liz. A big part of this is position squaring. There were some people who were making long duration calls earlier, just a couple of months ago, saying that, hey, there's going to be a recession later this year, so you want to buy duration in that situation. And, that doesn't seem to be panning out the way that a lot of people thought. We thought that we wouldn't get a recession until sometime next year. So, we thought that the Fed was going to be on hold, and you'd wind up seeing not this kind of move, but something not dissimilar. What I can tell you, this is not a reflation trade. So some people have been saying, oh, inflation's going up, that's why the long end's selling off. It's not. If you look at inflation break-evens, they're only up a couple of basis points. Most of this move is real yields. So that tells you that it's volatility and its supply are probably the two single biggest things that are moving this market right now.
Liz, do you think that the equity market is ignoring what the bond market is doing?
Well, I think, like today we're mixed all around, right? Equities were down, then some were up. And like you said, we've got these big earnings coming after the close. So I think for a while there was, like the equity market just seemed like, whether it's FOMO or whatever, people felt like, wow, like 5% on a T-bill is nice, but the S&P was up almost 20%, right? So they were like jumping back in. But now I think with the break, like Ira said, people thought yields would go higher. I don't think a lot thought they would break this high this fast. So I think it is starting to kind of filter into equity minds. But we'll see. I would suspect if Apple and Microsoft come out with good earnings, I'm no equity person, I have no idea, but that you'll see some of that kind of tech momentum come back. But yeah, I do think the equity market is finally paying attention more. Like I think, Maddie, you said at the start, how can you kind of not? Yields have gotten so high so fast.
Well, I'm curious then, Ira, from your perspective, does the bond market listen to the equity market at all? If we see Magnificent Seven bump up after...
I heard the bond people are supposed to be the smart people.
Yeah.
Well, maybe on the economy and that we can do bond math, but outside of that, I'm not sure how much smarter we really are. I think one of the big things about looking at risk asset versus what's going on in the Treasury market is the market move this week has been very technical. You look at it started really when we got the much higher than expected borrowing estimates out of the Treasury Department late Monday afternoon, and since then, you've just had more and more kind of negative news for the bond market. Now, remember, we are steepening. The yield curve is steepening, and it's bear steepening. That's pretty atypical. That doesn't happen very often. And one of the reasons I think that it's occurring is what we talked about earlier, is some of the economic data that we're getting and this kind of repricing of the expectations of when we're going to get a recession. So if the Fed is on hold, we're pretty much where they are now, but you're not going to see cuts until 2025, then you have to reprice the entire curve. And I think that's part of what's going on today, along with the extra supply. And look, it's not even the amount of supply that we're getting in aggregate, right? Because they are issuing a lot of T-bills. The Treasury Department is issuing that. It's that there's going to be $3 billion more of 10-year notes next week, plus $2 billion more of 30-year. That's a lot of duration for the market to have to absorb in the summer when you have people on vacation, people not willing to take risk, along with uncertainty. So this is completely a rational move given all of the information that we've seen. It's not like there's a mispricing out there, and we haven't reached the cycle highs yet, right? We haven't reached at 4.35% that we got to last October, and I think until we get there, like that's the next stopping point if we continue to sell off because of this illiquid market activity.
Liz, is U.S. yield curve control coming soon?
Yeah, I've seen that memo going around, and I say no.
I can see Ira on Zoom shaking his head.
You're
as well.
Liz, offended at the question. No.
Yeah. Ira and I were an easy no on that one. Yeah, I'm going to push back on that. Yeah, definitely not. Fed, of course, is always doing what they have to do for their mandates, right? And I think what Ira said towards the end is very important, that there's a lot of people thinking, oh my goodness, maybe this higher for longer Fed, who people kind of pushed off, in recent weeks, oh, cuts are coming, that this may have to happen. And also there's talk hey, maybe the end point, even when they start cutting, that terminal rate is a little higher than they think. So I think that's just kind of a wave of a rethinking, people realizing, oh, if this goes on, even if the Fed doesn't hike again, or even that they just hike one more, it's on the other side. What if they just keep rates sitting there all year next year, or only cut in the second half? That's a lot of potential bond pain for a while.
Liz, what do you make of these big names who've come out in the last 24 hours and made their positions really public? Ackman shorting the 30-year. Bill Gross just now saying on the platform formerly known as Twitter that he's overall bearish on 10-year yields. What do you make of that?
Yeah, well, I would say, I'm going to be a little bond wonky, but I think Ackman, who we made clear, he's doing this in options as a hedge. He thinks it's a good idea. Elon Musk, if you watch that Twitter thread, he was like just coming back like Buffett. We have saying he's buying a lot of T-bills, but he always buys T-bills because he has a ton of cash because he's waiting for the next deal. So all my cash would be in T-bills too. So, and then Musk is saying, yeah, T-bills are great. Musk is doing a lot of other things. So I think it's like Ira was saying, duration of where you are on the curve. Buffett is, really got a lot of cash, throw that in bills. And I don't disagree with Ackman. Why not take a hedge? He's got the money, he's got a lot of other investments. You buy options. If rates keep going up, he makes some money.
Ira, where do you see the yield on the 10-year going? I mean, it's so high right now compared to where it was and where it's been over the last year. You look at mortgage rates, and they're over 7% right now. It's doing terrible things for housing affordability in the country. Where do you see the yield on the 10-year going?
Well, we constantly are reevaluating based on incoming data. We still think that if we do get a recession, as Anna Wong and her team at Bloomberg Economics thinks, that we're going to, if we do have that recession later this year, you can wind up getting a 70, 75 basis point rally pretty quickly over the next couple of months. And that sounds crazy, but look, you go back to last November, and we had a move very similar to that at the end of 2022. So it's not that, people can wind up buying because they're, maybe offside, or if the economic data, starts to slow down, as some economists think, then clearly there could be a significant short covering rally that we can see. You look at a lot of positioning, and it's really all over the place right now. You have people long cash bonds, but then they're short futures. You look at speculators, they were short Treasury futures as they've ever been in terms of duration weighted and risk weighted positioning. So, you can wind up getting massive moves that are, I don't want to say unprecedented, because, look, I grew up in the 1980s, so I know that, moves can be very dramatic and hundreds of basis points in a month. But I think you can have a swift turnaround, if you just start to get a little bit weaker data than we've gotten in the recent past.
All right. Oh, you go ahead, Maddie.
We are going to have to leave it there. I'm sorry.
Great minds think alike. You hear the Killers music, we know it's time to wrap.
Exactly. Ira Jersey, thank you so much for joining us, our Chief U.S. Interest Rate Strategist and Chief Correspondent for Global Macro Markets, Liz McCormick. We will be back with more news for you after the break. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:21 on Wall Street. We do check markets all day long at Bloomberg. The Dow, the S&P, NASDAQ 100 index, and yes, the Russell 2000 all in the red right now. We've got the S&P down 9, drop there of 0.2%. 38 minutes to go ahead of the closing bell, with the Dow down 45. Right now, that is a drop of 0.1%. NASDAQ Composite Index also down by 0.1%. NASDAQ 100 index down by 0.14%. 10-year yield at 4.18%, with a 2-year that's yielding 4.89%. Spot gold, $19.33 the ounce. Little change there, down just about 0.1%. West Texas Intermediate crude, though, rallying 2.6%, now at $81.58 a barrel on WTI. Traders, meanwhile, are awaiting results out of Apple and Amazon, two of the mega caps that have been critical to the rally in stocks this year. Apple ahead of earnings, down 0.7%. That number expected roughly 4:30 p.m. Wall Street time. We've got Amazon higher now by about 0.5%. So another down day for the U.S. stock market. Mona Mahajan is senior investment strategist at Edward Jones. She is not attaching too much significance to the stock market decline.
Keep in mind, the S&P has been up nearly in a straight line since March of this year, 18%, the NASDAQ up 25%. There's really no arguing that we were due for some sort of pullback. In fact, a pullback in our view was probably not only due, but healthy.
You can hear more of that conversation on the Bloomberg Surveillance podcast. You can download it wherever you get your podcasts. After earnings, Expedia down 16.2%. Qualcomm after earnings down 8.5%. PayPal after earnings down 11.8%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. Really do appreciate it. We promised that we'd bring you updates throughout the program today about former President Donald Trump making his way to the federal courthouse. Well, he's indeed arrived at the federal courthouse in Washington for arraignment on charges that he conspired to obstruct the 2020 presidential election and interfere with the voting rights of millions of Americans. If you're watching us right now on YouTube, which you can do by searching Bloomberg Global News, you'll see the shot up there on the right outside the courthouse. President Trump's motorcade pulled in to an underground garage. There were some supporters, there were protesters. They waited behind police barriers outside. The court building stands within sight, we should note, of the U.S. Capitol that was attacked, Maddie, by mobs of his followers on January 6, 2021, as Congress was certifying President Joe Biden's victory.
Yep, and it's in the Capitol that former President Trump is potentially going to be sworn in again as he runs for president another time here. Having said that, we're going to continue to update you on former President Trump's arraignment there in D.C. But first, we do want to get back to markets. At the start of our show, we let the bond market take center stage, as they have been for the past couple of days. But stock investors, we want to get to you too, because stocks overcoming a degree of skittishness about those rising yields, seeing some profit taking, some strong earnings. The S&P a little bit changed, having earlier fallen about 0.6% in an extension of that Wednesday sell-off. So still seeing some fluctuation ahead of the jobs report and, of course, those big earnings from Apple and Amazon. But we want to talk about some of the catalysts behind all of these moves today. So here with us, Bloomberg Equity Markets reporter Elena Popena joining us on Zoom, and in studio with us, equities reporter Alexandra Semenova. Thank you both so much for joining us this afternoon. Alex, I want to start with you because you follow the macro view of markets so closely. I know there have been a lot of calls in the past few days. Which ones have stood out to you the most?
Yeah, it's great to be on with you guys. Of course, we're seeing a little bit of a pullback in the equity market amid the turbulence that we're seeing in the bond market. A lot of people are crediting the downgrade by Fitch on U.S. credit for what's happening, but a lot of business leaders, strategists, investors are all calling this a non-event. We, of course, had J.P. Morgan CEO Jamie Dimon, Bank of America CEO Brian Moynihan saying this is not really something to worry about. Daniel Loeb of Third Point said that this is a cry for attention by Fitch. So that's not really the concern. I think Citigroup's Stuart Kaiser put it well. He said that it's not really the downgrade that people are worried about, but a combination of small events that have conspired to move yields higher, given the incredible run that we've seen in equities. Elena actually had a terrific taking stock column in the Bloomberg terminal the other day. We went 47 straight trading sessions without a move of 1% or lower on the S&P 500. So we were kind of due for this pullback. And the view so far seems to be that there's nothing really yet to suggest that this could be a bigger risk-off event.
Hold on. I'm so glad you brought that up, Alex, because I'm looking at this taking stock column right now. And Elena wrote this at 7:54 a.m. yesterday. And certainly we had a view on what futures would do, but we had no idea. I mean, I had no idea that
Absolutely
the S&P
no clue,
500 would close down 1.4%. Elena, did you know? Because it's like you kind of read the market's mind yesterday morning.
I had no idea, but accidentally I jinxed it. We are overdue for a correction. There hasn't been a 5% correction in the S&P 500 since the banking crisis in March. We've been up for 5 consecutive months. It may be time for a breather. So it's not necessarily, a big risk-off event. The most equity indexes are in the red, but we are not talking about, just a total market capitulation. Yes, the weakest parts of the market are doing worse. For example, profitless technology stocks, the Goldman Sachs group of the most money-losing tech stocks. This basket declined the most since November yesterday and is down another 1% today. So some of the shadiest parts of the market are feeling more pressure than some of the strongest parts than the S&P 500, for example.
Yeah, Elena, I want to stick with you for a second because I know you follow the options space so closely as well. Is there anything going on when it comes to options that can give us a clue as to what we're seeing in the equities market overall today?
What is happening is options traders are putting more emphasis on tomorrow's jobs report and on next week's CPI reports. Back earlier this year, these two events were more or less a non-event for volatility traders. So what they did was they bought protection, both upside and downside, and then they did not end up needing that protection. So they said to themselves, well, why bother? Right now, it's a different environment. We may spiral into a bigger sell-off. Things may fall, another couple of percentage points from this level. So they do need more protection, and that's what they are doing. They're buying more protection ahead of tomorrow's event and ahead of next week's CPI. So it's going to be an interesting development.
But Alex, if that does happen, if we do see some sort of pullback in the S&P 500, there's so much dry powder on the sidelines. There's so many people who've missed out on this rally because it happened so quickly in such a short period of time. Are they going to just jump back in?
Exactly. So as Elena said, there is more focus right now on the macro. If you look at the last couple of days, there's nothing really that has changed the bull case. Soft landing optimism is still intact. We're still nearing peak rates. But of course, it depends what we see from that jobs report tomorrow. That's really going to determine how investors are feeling about the rest of the year. But, even if we do get a jobs report that renews worries about where interest rates will go, one of my sources, Jay Hatfield over at Infrastructure Capital Partners, I know he's a friend of the show and he comes on often. He's great. He was telling me that he thinks that so many people have missed out on the rally that they might see the pullback as an opportunity to step into the market and get some of their cash off of the sidelines. So we won't get this Armageddon type of sell-off that a lot of investors are worried about.
Because they see it as an opportunity.
Exactly. So they'll start to pile in. The ones that have missed out on the rally, that have been, sitting on cash, will say, okay, the market is, going through a correction. Now is a good time to buy stocks.
So I'm curious then about when we know that the pullback or the profit taking is kind of wrapping up. What are your sources telling you about that, and what does that sort of start to look like?
Yeah, so, of course, people are seeing this volatility as a good time to do some profit taking. Citigroup's flows data showed that long positions on the S&P 500 suggested that profit taking risk was, something that people were kind of expecting, especially ahead of some big events that we have. We have the tech earnings today and the jobs report tomorrow. So before they get those reports, they kind of wanted to lock in their gains this year. But we'll have to see what comes out of those reports before we can really tell what, things will be looking like. Julian Emanuel over at Evercore ISI was on Bloomberg TV this morning. He made a really good point. He says that even though he does see a recession at some point in the next 12 months, there is nothing yet that points to one in the imminent future. So as long as, the soft landing case is still intact, equities can continue their run.
Is there anything that could happen tomorrow, Elena, that could sort of defeat the narrative?
For sure.
Defeat the narrative?
First of all, Apple and Amazon earnings, the jobs data tomorrow is going to be critical after ADP report was much hotter than expected. So that,
Okay, so let's take one of these things at a time. Okay, so if the ADP report comes in hotter than expected, the concern, of course, is that the Fed will have to raise interest rates more.
Right, the jobs report is going to point a similar picture. Now, the ADP report has a lot of flaws. We don't know yet if that hotter than expected print is actually materialized on Friday. But with that in mind, we have a jobs report at 8:30 a.m. Friday after critical earnings reports from Apple and Amazon, the two stocks that helped lift the broader stock market higher.
Which of those two stocks later today is more important as a broader tell of the global economy? I have my own view, but I'm curious about your view, Elena.
Apple for sure.
Yeah.
It's a big AI play at this point, and it's a big play on consumer supply and demand, with its new iPhone 15 lineup potentially later in early September, and Apple being a broader barometer of consumer health, and consumers have helped take the economy out of recession or helped skirt the recession. So that is of course a big issue with Apple reporting after the bell.
All right. Of course, the China story as well is one that I'm going to be watching closely too, to see the health of the consumer in China, because the greater China region for Apple, Maddie, is such an important one. We're going to have to leave it there for our stock segment. We did bonds. We're doing stocks. A big thank you to Bloomberg Equity Markets reporter Elena Popina and equities reporter Alex Semenova joining us on the latest with the markets. Speaking of what the markets are looking like, well, we're seeing some red on the screen. The S&P down more than 0.1%. The NASDAQ is flat, and the Dow just down fractionally right now. Let's go to Washington, D.C. for a check of the latest world and national news. Nancy Lyons is in the Bloomberg 99.1 newsroom in Washington, D.C. Hey, Nancy.
Thanks, Tim. Donald Trump has arrived at the federal courthouse where within the hour he will surrender to authorities on charges of conspiring to obstruct the election of his successor. We get more from Bloomberg's Irv Chapman.
Special counsel Jack Smith constructed a case free of complications that might delay a speedy trial. Nick Ackerman, who is one of the Watergate prosecutors against Richard Nixon, said in a Bloomberg interview.
Trump has really created a Watergate on steroids here. There's nothing complicated about this. It's purely based on witness testimony, tape recordings of Donald Trump, and documents that will corroborate witnesses.
Ackerman added that when the evidence was in, Republican leaders like Senator Barry Goldwater told Nixon he had to resign. But that's not how Republican senators are behaving now. In Washington, Irv Chapman, Bloomberg Radio.
A group of Democrats is pushing House Speaker Kevin McCarthy to schedule votes on gun violence as soon as possible. More than 100 Democrats signed onto the letter arguing that the need to address gun violence is urgent. They criticized the Republican-led House for not bringing a single gun reform bill up for the vote this year. More than 400 mass shootings have occurred in 2023, according to the Gun Violence Archive. Half of Americans say the U.S. economy is still getting worse. According to a CNN poll, 51% of Americans say the economy is continuing its downward trend despite some positive indicators. Only 1 in 5 said the economy is on the road to recovery. Singer Taylor Swift is posting on her social media accounts that she's adding 15 new shows to her calendar in the fall of next year when she returns to North America for a second leg of the Eras Tour. The initial tour is on pace to gross over $1 billion. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries.